Hey guys, welcome back to the revision series. In the previous video, we have successfully completed revising the SA 200 series of the standards. Now in this session, we are going to revise SA 500 series of the standards. What we are going to revise on the session? So we are going to concentrate mainly on SA 500 series. So SA 500 series is very important series of the standards. Why? Because all the underlying foundational aspects of the entire subject of the audit will be contained in SA 500 series only. So as we all are aware, SA 500 series are the standards which are talking about audit evidence and related matters. The different aspects relating to audit evidence. Like we have SA 500, which is talking about overall audit evidence in general. That standard we have already revised it long ago. So apart from SA 500, there are various standards under SA 500 series. Like we have SA 501, which is going to talk about how to obtain audit evidence regarding inventory, how to obtain audit evidence regarding litigations, how to obtain audit evidence regarding segment reporting. We have SA 505, which is talking about how we can use external confirmation as a audit evidence. 510 talks about how to obtain audit evidence regarding opening balances. SA 580 talks about written representation. 560, 570, 540. So like that, we have n number of standards under SA 500 series, which are very conceptual. The knowledge of these SA 500 series of standards is going to be damn important, especially if you don't strongly understand the concept of the 500 series. It becomes very difficult for you to understand the questions, and particularly case scenario based questions. Why? Because case scenario based MCQs will be mostly rounded around audit evidence related matters only. So if we are not that comfortable with audit evidence and related aspects, then I'm telling you it becomes greatly difficult for us to understand the overall concept of the auditing subject. So that's why 500 series are going to be that important. So they contain a lot of important information, and having a strong knowledge of this SA 500 series will equip you to understand all the questions given in the examination, and especially you will be very comfortable in answering the case scenario based MCQs. So that's why don't skip this part. So definitely you have to watch this, definitely have to go through this 500 series of the standards. So having said that, I will not waste much of your time. So we will be first starting our revision with SA 501. We'll be starting our revision with what? SA 501 we will start. And one more thing here. So for the purpose of this revision, I'm going to make use of charts. I'm going to make use of charts for the purpose of revision, and a caution which I always give. So first you have to read the content from the main material. Charts you have to use it only for the revision. Charts you have to use it only for the revision, but at least once you should have read the content from the main material. So at the time of your preparation also, don't completely rely on the charts. First read once entire content from the material, prepare from the main material, then use this charts for the purpose of revision. And these 500 series of the standards I will be revising with the help of that charts. You all know where to download that charts. Once again, I'm repeating. So just go to the website www.fingamesacademy.com. Go to the resources section. Under the resources section, you will be able to find all the resources, whatever I'm going to use in the marathon. Clear, everybody? So let us start our discussion with SA 501. Right. So SA 501, which is talking about audit evidence, specific considerations for selected items. Sir, what does this standard talk about? See, this standard is going to talk about how to obtain audit evidence. But you will say, sir, for obtaining audit evidence, we have already discussed one standard. There is already a dedicated standard which is talking about audit evidence, which is SA 500. So SA 500 is also a standard talking about audit evidence only. But there is a slight difference. See, SA 500 is a standard talking about audit evidence in general. It talks about the entire audit evidence. Whereas SA 501 is a standard talking about audit evidence, and this standard is talking about only regarding selected items. So this standard has particularly identified 3 items of the financial statements and how to obtain audit evidence regarding that 3 selected items. What specific considerations you have to keep in mind for obtaining audit evidence regarding that 3 selected items. Regarding that only SA 501 is going to give the guidance. So SA 500 is a general standard talking about overall audit evidence, whereas SA 501 is a specific standard talking about audit evidence, which is going to guide us how to obtain audit evidence regarding only 3 selected items. Sir, what are that 3 selected items regarding which this standard is trying to give the guidance? So the 3 items which are selected for which the standard is going to give the guidance is: number 1, this standard is going to help us out to obtain sufficient and appropriate audit evidence regarding the existence and condition of inventory. So first item regarding which this standard is going to give the guidance is how we can obtain audit evidence regarding inventory. Number 2, this standard is trying to help us out to obtain audit evidence regarding completeness of litigations and claims. Second item regarding which this standard is going to give us guidance to obtain audit evidence is completeness of litigations and claims. Third one, this standard is going to guide us how to obtain audit evidence regarding segment information. So three items regarding which SA 501 is giving guidance. What are they? Obtaining evidence regarding completeness, existence and condition of inventory, completeness of litigations and claims, segment information. Now let us try to understand what guidance does this standard give regarding each and every item. So what the standard is telling, what we can do to obtain audit evidence regarding existence and condition of inventory, what we can do to obtain audit evidence regarding a completeness of litigations and claims, what we can do to obtain audit evidence regarding presentation of the segment information. So first we will talk about existence and condition of inventory. See, this standard is going to talk about two things. They are asking us to obtain audit evidence regarding existence also and regarding condition of the inventory also. Sir, what is this existence and condition? This I will try to explain it with the help of one simple example. Please pay attention. Guys, assume that you are conducting audit of some entity. Okay, so in that entity's balance sheet you are able to find inventory worth 100 crore rupees. We all know what is the basis for this valuation. So this 100 crores, how this value has been derived is, assume that there are 10 lakh quantity of stock. There are how many quantity of stock? 10 lakh quantity of stock. So cost is 1000 rupees, whereas NRV is 1100 rupees, whichever is lower, so that will be 1000. So if you calculate in that manner, the value of the inventory has been 100 crore rupees. Now we want to know whether the value of this inventory of 100 crores is correct or not. In order to decide whether this value of inventory of 100 crores is correct or not, that depends on whether the quantity used for valuation is correct or not, the NRV used for valuation is correct or not. Why? Because cost is very simple. Cost we can find it out from the books of accounts. Where the difficulty comes is finding out the evidence regarding NRV. So if this value of 100 crores has to be correct, then the quantity which is used in valuation of the stock, that should be correct, and NRV should be correct. So we need to obtain evidence. In order to know whether this 10 lakh quantity is correct or not, we need to verify the existence of this stock. So whether 10 lakhs quantity of stock is there existing with the company as on the balance sheet date. So that is what the meaning of existence of inventory. Whatever quantity that has been used in the valuation of the inventory, that much a quantity of stock is existing with the company as on balance sheet date, that we need to obtain evidence. Number two, condition. See, condition is something which is having an impact on NRV. Condition means what? If I put it in simple terms, the quality of the stock. See, NRV of the stock will be influenced by its condition. For example, if I give you one simple layman example to understand, take an example of vegetables or fruits. See, the vegetables or fruits, the day they are brought to the market, assume they are getting sold at 100 rupees. So on first day they are brought to the market, their NRV is 100 rupees. 1 day passes, 2 day passes. So now the quality of that will get reduced. The condition will get deteriorated. Then the fruits and vegetables will be able to fetch only 80 rupees per kg. 2 more days passes, then what will happen? The value will further come down. It will be able to fetch only 60. So if you see here, this 180-60 is nothing but NRV. And if you pay close attention, this NRV is getting influenced by the condition of the stock. NRV is getting influenced by what? Condition of the stock. So if you want to obtain audit evidence whether inventory value which is shown in the balance sheet is correct or not, we need to obtain evidence whether the quantity which is used in the valuation of the stock is in existence. Number two, what is the condition of that inventory? So that we need to obtain evidence. Now, how to obtain that audit evidence, sir? Okay, we understood what is the meaning of existence, what is the meaning of condition. Sir, as an auditor, how can I get to know about the existence and condition of inventory? What I can do? You think practically, ignore what the standard is telling. You think practically, if you want to obtain audit evidence regarding existence and condition of inventory, what you should do? Inventory verification, physical verification you have to do. See, generally what the standard says is every management will try to do inventory counting. The management of every organization, they will do the inventory counting of their stock. So most of the organizations will do it as on the balance sheet date. Some organizations will do it other than the balance sheet date. But at certain point of time, management of the organization will do their inventory verification. So what the standard is asking the auditor to do is, auditor shall attend management inventory counting process. So whenever the management is doing their inventory counting, generally every management of the organization will do the inventory counting. So as an auditor, what is your responsibility is you should go and attend that inventory counting process. Whenever management is doing that counting, they will tell you, sir, on so and so date, we are going to verify our stock. We are going to do our inventory counting. Management will tell you. As an auditor, your responsibility is to go and attend that inventory counting process. Sir, by attending, what I should do? So by attending, what you should do is evaluate the management process. Try to understand what process management is following for doing that inventory counting. Number two, observe the management counting. You sit there and observe the counting process. First, try to understand what process they're following. Then you sit there and observe the management counting. If you are feeling bored, you also go and inspect the inventory. You go and check the quality of the stock on your own. And also what you can do is you can perform the test counts. You can also randomly pick some items and you can do the counting on your own. Able to understand? So first step, in order to obtain audit evidence regarding existence and condition of inventory, management will do inventory counting. As an auditor, you should try to attend that inventory counting process done by the management. And by attending, there are 4 things you have to do: evaluate the management process for counting, observe the inventory counting process, inspect the inventory, and also perform the test counts. See, sometimes what will happen is management will be doing physical verification. Management has invited you, but you were unable to attend that inventory counting process. Management is doing inventory counting, but they even told you, as an auditor, they told you, sir, on so and so date, we are going to conduct the inventory counting. They even informed you. But as an auditor, you were unable to attend that management counting process. Maybe you are busy, maybe you are out of station, maybe you are occupied with some other work, maybe your personal reasons are there. So whatever may be the reason, management has did the inventory verification, but as an auditor, you were unable to attend that inventory counting process done by the management. Then what I should do, sir? Then the standard simply says, auditor shall himself do the physical verification if he is unable to attend that management's counting process. See, if the management is counting and if you have attended, your responsibility will be very less. You can sit and just watch. In case if you are unable to attend that inventory counting process done by the management, what as an auditor you should do is, you should take your team, go to inventory verification on some alternative date and do the counting on sampling basis on your own. If you attend management inventory counting process, you can sit and enjoy that. If you are unable to attend the management's inventory counting process, you have to take your own team, go and do the inventory verification on some sampling basis on some alternative date. See, sometimes what will happen is, management conducted inventory counting. They invited you. You are unable to go. You thought that you will do the verification on your own. But now what it has become is, it has become highly impracticable. What it has become highly impracticable for the auditor to go and do the physical verification. You did not attend management's inventory counting process. You thought of doing it on your own on some alternative date, but that has also become highly impracticable. Then what you will do, sir? So if physical verification becomes highly impracticable, that means might be floods are going there, social riots are going there, whatever may be the reason, you thought of doing the physical verification on your own, but that has become highly impracticable. Then what auditor should do? Then auditor should perform alternative audit procedures. What auditor should do? Alternative audit procedures. You are not able to do physical verification and obtain the audit evidence, no? You try to think any alternative procedures you can do in order to obtain evidence regarding existence and condition of inventory. Sir, what could be alternative audit procedure? It could be anything. The standard did not mention anything. The auditor should apply his professional judgment and he has to decide what I can do alternatively to obtain the audit evidence. See, if by performing alternative audit procedures, if you are able to get the evidence, okay, sir, I am unable to perform alternative audit procedures, or you performed alternative audit procedures and then also you are unable to obtain the audit evidence, then what you should do, sir? Finally, you have to modify the opinion. Sir, which kind of modification? So either qualified or disclaimer. Why? Because this is a case of non-availability of audit evidence. Clear? Simple. 4 steps, guys. If the management is doing inventory counting, auditor should attend. If not possible, you try to do it on alternative date. If that has become highly impracticable, try to perform alternative audit procedures. If alternative audit procedures are also not giving audit evidence, then you have to modify your opinion. That's it. And what kind of modification? Either qualified or disclaimer. Here one important sentence is there, which is typically example from the examination perspective. I will show you that sentence, or from true or false statement perspective also, that is going to be damn important. I will show you. Say 501, where is it? Just give me a moment. That sentence is very important. Why I am telling you, just understand the importance. Why I want you to take you through that particular statement. The complexity is like that. See here. This one. Not this one. Yeah, this sentence. The difficulty of time or cost involved in itself is not a valid basis for physical verification impracticability. See, just now I told in the standard, if the physical verification becomes impracticable, then you need to perform alternative audit procedures. Sir, what is impracticability? Can the auditor say, see, I am incurring a difficulty of time. That means if I have to attend the inventory counting process, I have to travel for 6 hours. Or I will incur more cost. I have to incur travel expenses in order to visit that warehouse. Can that be taken as impracticability? No. When I say impracticability, that impracticability should have been created because of circumstances beyond the control of the auditor. The auditor can't use the difficulty of time or difficulty of cost as a reason for impracticability. You can't use that as a reason for impracticability. So this sentence is very, very important. How they might ask you a true or false statement is, they will say the difficulty of time or cost is in itself a valid basis. No, it is not in itself a valid basis for physical verification impracticability. That means I am facing difficulty of time, I am facing difficulty of cost. That's why it is impracticable. I will perform alternative audit procedures. Standards will not accept. When they say impracticability, that impracticability should have caused because of circumstances beyond the control of auditor. That's it. And one more thing also the standard will talk about. See, sometimes what will happen is you will be the owner of the stock, but that stock will be in the custody of third party. See here, that sentence also I have added. I told you, no, the standard, this charts I have prepared in a very comprehensive way. Sometimes what will happen is you will be the owner of the stock, your client will be the owner of the stock, but that stock will be lying with the third party. So inventory is in the custody of third party. Sir, when will be the inventory in the custody of third party? Simply, for example, if you have sent the goods on consignment, you have sent the goods on job work basis. In these circumstances, you will be the owner of the stock, but that stock will be lying with the third party. Am I required to obtain evidence regarding that stock even lying with the third party? Yes. So even the stock which is in the custody of the third party, regarding that also auditor need to obtain audit evidence. How the auditor will obtain audit evidence, sir? So in case the inventory is lying in the custody of third party, you need to obtain audit evidence by way of getting external confirmation. Number one, try to obtain that external confirmation from the third party. For example, if the stock is there with the consignee, ask the consignee to give a confirmation how much stock he is holding. If the stock is with the job worker, ask him an external confirmation. See, generally external confirmation evidence will be reliable, but in some circumstances, if you find that even external confirmation is also not reliable, might be the third party is a relative of your client, so you got a doubt that even external confirmation is also not reliable. If you have any doubt external confirmation is not reliable, you need to perform additional procedures to obtain evidence regarding that inventory which is in the custody of third party. That additional procedures could be, if possible, you try to attend that third party's premises also, or you can arrange some another auditor. If in that third party's premises, if you know somebody else, some other auditor, you can arrange that another auditor to visit that third party's premises, or even you can verify the documentation happening between your client and that third party. Clear? So these are the steps which auditor is required to follow in order to obtain evidence regarding existence and condition of inventory. So first item we are done with. Now let us come to the second item. What is the second item regarding which we need to obtain audit evidence? Completeness of litigations and claims. That means whatever cases, whatever litigations, whatever claims which your client is going through, whether all that litigations and claims are completely presented in the financial statements. For example, if your client is going through a pending case, if it is certain that your company will lose the case and you have to pay the amount, then it should be reflected in the financial statements as a provision, as a liability. In case if the case is going on against the company and if we don't know the outcome, then we have to disclose it as a contingent liability. So no matter the outcome, the liability is required to be presented either as a part of the provision or as a part of the contingent liability. So as an auditor, I need to obtain audit evidence, whatever litigations and claims which the client is going through, whether they are completely presented without ignoring anything in the financial statements. Sir, regarding this, how can I obtain audit evidence? So we need not break our heads for that. SA 501 is giving guidance. So what does the standard say? How can we obtain audit evidence regarding completeness of litigations and claims? First, what the standard will ask us to do is try to identify, is there any risk of material misstatement in the area of litigations and claims? They're not asking you to directly go and find out whether there is a misstatement in the litigations and claims. They're not asking you to directly go and find out, has the management hidden any pending litigations and claims. First, what the standard is asking you to do is try to identify risk of material misstatement. Try to find out, is there any possibility that a management could have hidden the litigations and claims? Sir, how can I identify that risk of material misstatement regarding litigations and claims? The standard itself is telling do three simple steps to know whether there is any risk of material misstatement in the litigations and claims. So what are that three simple steps? Very simple. Number one, go and inquire with the management and in-house legal counsel. First, go and inquire with the management and internal legal team. If it is there, go and inquire with them. Sir, did you disclose all the litigations and claims or have you hidden anything? First, go and inquire. Number two, read the minutes of those charged with garnants. Number two, what you can do, you can go and read that minutes of the meetings of those charged with governance. Number three, review the legal expenses account. Verify do an in-depth analysis of legal expenses account. Try to compare it with the last year. So like that, you do some kinds of analysis. So first, to do these 3 steps and identify, is there any risk of material misstatement? Is there any chance of misstatement happening in the litigations and claims? What are the 3 steps? Number 1, inquire with the management and in-house legal counsel. Number 2, read the minutes of those charged with governance. Number 3, review the legal expenses account. Now, by doing these 3 steps, 2 outcomes could be possible. What 2 outcomes could be possible? The auditor might find a risk of material misstatement. The auditor might not find a risk of material misstatement. If the auditor did not find out the risk of material misstatement, the auditor performed the above 3 steps. If he did not find out any risk of material misstatement, his responsibility will be over. He need not do anything further. His responsibility comes to end by performing these 3 simple steps. So by performing these 3 simple steps, if the auditor did not find any risk of material misstatement, then and there his responsibility will come to an end. He need not do anything further. But in case after performing these 3 steps, if the auditor finds out the risk of material misstatement, then he need to perform some extra procedures. Able to understand? So by performing these 3 steps, if the auditor finds the risk of material misstatement, then he needs to perform some more procedures. What he needs to do? So if there is a risk of material misstatement, first auditor, what he should do is, the auditor shall communicate with entity's external legal counsel. So generally company would have appointed some external lawyer to fight the case, no? So if you find any risk of material misstatement as an auditor, you have to communicate with that external lawyer who has been appointed by the company for fighting the case. But generally external lawyers appointed by the company might not respond to the auditor, or even auditor will not know whom to exactly communicate in that entity's external legal counsel. So how the auditor should communicate with entity's external legal counsel, sir? Through a letter of inquiry. Whatever information you want to get, you put it on a piece of paper. And you should ask the management to draft it. Why? Because as an auditor, I don't know whom to communicate. Whatever information you want, you put it on the paper. You want to ask it through the letter of inquiry, but ask the management to prepare the letter of inquiry. Why we have to ask the management to prepare? Because they will come to know whom to communicate, how to communicate, in which manner if you communicate, you will get the response that will be known by the management. So the auditor shall communicate with entity's external legal counsel through a letter of inquiry, which is prepared by management and sent by auditor. And in that letter of inquiry, we will ask entity's external legal counsel to respond back directly to the auditor only. Able to understand the flow, guys? If you find risk of material misstatement, you have to communicate with entity's external legal counsel. How, sir? Through a letter of inquiry. Who will prepare it, sir? Management. Who will send it, sir? Auditor, sir. And we will ask the entity's external legal counsel to respond back to him, to the auditor directly. See, if everything happens smoothly, then no issue. But when the problem will arise, if the management is refusing, I asked the management to come to draft a letter of inquiry for me. Management told no. Or management permitted me, they drafted a letter of inquiry, I sent it to the external legal counsel, but external legal counsel did not respond. He's not giving a reply. Or he's prohibited from responding because of some laws and regulations. External legal counsel is prohibited from responding. See, if everything happens smoothly, well and good, we can continue the audit. But when the problem arises, I want to communicate with entity's external legal counsel, but management is not allowing me. Or management allowed me, but external legal counsel is not responding back to me. Or he is prohibited from responding. In these circumstances, what I should do? In these circumstances, what you should do is, you should try to perform alternative audit procedures. So what could be alternative audit procedures? Once again, it is up to the auditor's professional judgment. So if you are unable to communicate with entity's external legal counsel because of these reasons, try to perform alternative audit procedures. Sir, if alternative audit procedures are also not possible, as I have told, modify the opinion. Which kind of modification? Since it is a case of non-availability of audit evidence, you have to give either qualified or disclaimer. Understood? So in addition to all that, even you need to obtain written representation from the management that they have disclosed all the litigations and claims and they have provided complete information to the auditor. Ask one written representation also. And in some circumstances, the auditor might feel that communicating with the entity's external legal counsel through a letter of inquiry alone will not be enough. He might feel that he is required to directly go and meet with entity's external legal counsel. In which circumstances that will happen? Generally, the standard is telling you are required to communicate with the external legal counsel through a letter of inquiry. But sometimes auditor might feel that just communicating through a letter of inquiry alone will not be enough. He might feel that it will be better if he go and directly meet with the entity's external legal counsel. Sir, when that circumstances will generally happen. So when the auditor might feel to directly go and meet with the entity's external legal counsel is, the risk is a significant risk. If you came to know that because of that litigation, the risk is going to be a significant risk. In that case, is just communicating with the letter of inquiry alone will not be enough. You might directly go and meet with the entity's external legal counsel. Or when the matter is complex, matter is very difficult to understand, then also you can directly go and meet with the entity's external legal counsel. Or when there is a disagreement between management and external legal counsel, management is trying to say something, external legal counsel, in way of response to the letter of inquiry, they are trying to say something else. So when there is a disagreement between management and the external legal counsel, then also auditor might feel to directly go and meet with the entity's external legal counsel. Here guys, this part is very important. In the previous examination they have asked a question out of it. The question which they have asked is, I will show you once, just for the sake of convenience, how the questions will be tested in the examination. So I'm showing that for you. Yeah, this question. So if you read this question, SPR Limited has been into the media business since 1990. During the financial year 2021-22, many notices were received by the company for hurting public sentiments, and financial claims were filed against the company. As an auditor of a company, you requested the management for arranging the meeting with the company's external legal counsel. Management is of the view that such meetings are necessary only in certain circumstances. Can you list down those circumstances? So auditor is asking, he wants to go and meet with the entity's external legal counsel directly, but the management feels that that meeting is required only in some circumstances. So what are that circumstances where communication, where meeting with the entity's external legal counsel will be appropriate? In these three circumstances: when the risk is significant, when the matter is complex, when there is a disagreement between management and entity's external legal counsel. Clear everybody? Right. So this is how you need to obtain audit evidence regarding completeness of litigations and claims. Now, one more part is there, which is this standard is talking about. This standard is also trying to help the auditor to obtain audit evidence regarding presentation of segment information. So how the auditor can obtain evidence regarding segment information, whether segment information is correct or not, how the auditor can obtain audit evidence? Very simple, guys. First, as an auditor, you need to understand the methods used by the management. See, in the accounting standards, we have a guidance how to identify primary segments, how to identify secondary segments. So first, as an auditor, we need to understand what methods are used by the management in identifying the segments. And also we need to understand how the sales, transfers and charges are happening between the segments. Comparison with the budgets. Budget wise, if segment wise, if budgets are there, try to compare the actual results with the budgets. And also allocation of assets, how the assets are allocated among different segments, that also you try to understand. And also you should ensure that there is a consistency with the prior period. Whatever policies they have followed for segment information in the prior year, whether it has been consistently applied in the current year. So as an auditor, you need to understand the methods which are followed by the management in presenting the segment information. Then also you need to evaluate whether whatever methods which are used by the management, whether they comply with the applicable financial reporting framework. Nothing but we have accounting standards which are talking about how to present the segment information. So first we will try to understand what methods are used by the management. Then we will evaluate whatever methods that are used by the management, whether they are as per respective accounting standards. That's it. So when it comes to segment information, there is nothing much to discuss. This is what simply we have to remember regarding segment information. Clear? So with this, we are successfully done with SA 501. Very important standard from the examination perspective. Compulsorily, you can expect a question from this standard. Okay, so I can say either in MCQs, true or false statements or descriptive questions, in any way, 4 marks compulsorily will come from the standard. And this is what all the standard is about, talking about 3 things. Clear? So successfully with this, we are done with SA 501. So now we will talk about the next standard, which is SA 505. Now we will try to revise SA 505. So coming to SA 505, SA 505 is a standard which is talking about external confirmation. Sir, what is this external confirmation? Guys, if you go back to the discussion, whatever we had in the chapter audit documentation and audit evidence, I told you that there are only 7 methods which are available for obtaining audit evidence. You take any audit procedure to achieve the outcome of that audit procedure, we have only 7 methods available. And if you could list that 7 methods, the 7 methods are inquiry, inspection, observation, external confirmation, recalculation, reperformance, and analytical procedures. So in that list, if you see, one of the technique or one of the method for obtaining audit evidence is external confirmation. So basically, external confirmation is one of the method or technique to obtain audit evidence, and it is one of the most reliable audit evidence. It is, since it is a external evidence. See, when I say external confirmation, it is getting generated outside of the client's organization. So that's why it is one of the most reliable audit evidence. So SA 505 is actually helping us out how we can betterly make use of external confirmation to obtain the best reliable audit evidence. So that is what all the standard is going to talk about. So how we can effectively make use of external confirmation to obtain the most reliable and relevant audit evidence. See, before we talk about the method, the guidance for sending external confirmation, we need to understand a few definitions. Number one, first we need to understand what is an external confirmation. The SA 505 has defined that an external confirmation is a direct written response. It is what? A direct written response obtained by the auditor from a third party or confirming party. See, when I say third party means someone outside of the client's organization. That could be debtor, that could be creditor, that could be banker, that could be supplier. So whatever direct written response. See, one more thing you have to pay specific attention. Only written response is considered as external confirmation. If you call and get a oral response from a third party, that is not considered as external confirmation. As per the standard, the definition is very specific. External confirmation is a direct written response obtained by the auditor from a third party or a confirming party. And that written response could be either in paper form or it could be electronic form. For example, if you want a confirmation, you can send a letter and you can expect the reply in a paper format. Or even external confirmation can be in the form of email also, WhatsApp message also, that is electronic format. So whatever it is, a direct written response obtained by the auditor from a third party or a confirming party, either in paper form or in electronic form, that we are going to call it as external confirmation. So one important takeaway from this definition, oral response will not be considered as external confirmation under standard. Clear? Now this external confirmation will be of two types. One is positive confirmation request and the other one is negative confirmation request. Sir, what is positive confirmation request? It refers to such a confirmation request where we expect a third party to respond, either he agrees or disagrees with the information. For example, if I'm sending a confirmation request in which as an auditor I'm telling, dear debtor, I'm auditor of so and so company. I came to know that you are a debtor for my client, and my client is saying that you are required to pay 1 crore rupees of money for them. Please reply back to me whether you are required to pay 1 crore rupees or not. So from this phrasing of the question, it is indicative that as an auditor, I am expecting a response from a third party. Either he agrees. If he agrees with that 1 crore, then also I expect a response. If he disagree with that 1 crore, then also I expect a response. So positive confirmation request refers to such a confirmation request where as an auditor, I expect a response from the third party. Either he agrees with the information or disagrees with the information. Whereas negative confirmation request refers to such a confirmation request where I expect the third party to respond only if he disagrees. When I'm expecting response in case of negative confirmation request, only if he disagrees with the information which is contained in the request. For example, if I'm an auditor, I'm writing a confirmation request to the debtor. I'm telling, dear sir, I'm an auditor of so and so company. I came to know that my client is, you are required to pay some amount to my client. My client is telling that you are required to pay them 1 crore rupees of money. Please reply back to me when you disagree. Reply back to me only when you disagree. So this is a negative confirmation request. Why? Because I am expecting a response from a third party only when he disagrees. See, sometimes confirmation request will be like this. Observe the terminology, whatever I am saying. So assume that I am an auditor and I am writing a confirmation request. Dear debtor, I am auditor of so and so company. I came to know that you owe some money to the client. You owe some money to my client. Please tell me what is the amount you are required to pay. See, here in this case, I'm not asking the third party to agree or disagree. If I'm asking the information directly from the third party, where it will fall? It will also fall under positive confirmation request. Why? Because I'm expecting response in all the circumstances, no? So that's why positive confirmation request will cover two scenarios where I expect the third party to respond, either he agrees or disagrees with the information, or if I'm asking the information directly from the third party. Or if I am asking information directly from the third party, that also will come under positive confirmation request. Whereas negative confirmation request refers to such a confirmation request where we expect the response of the third party only when he disagrees. If he is agreeing, then I don't want response. But you tell me, between positive versus negative, which one is more reliable? Positive confirmation request is more reliable than when compared with a negative confirmation request. Actually, negative confirmation request will give you less reliable audit evidence than when compared with a positive confirmation request. Does that mean auditor should never use negative confirmation request? No. Sir, then which one auditor has to use, sir? That is up to his professional judgment. I'm only telling when we do the comparison, negative confirmation request will be less reliable. But that doesn't mean auditor should use only positive confirmation request. No, we don't say that. So auditor can either make use of positive confirmation request or negative confirmation request depending upon his professional judgment. Clear? And one more definition, and two more definitions are there actually which we need to understand. One definition which we have to understand is exception. What is the meaning of the term exception? Exception means if there is a difference between information which is there in the confirmation request or books of accounts and the response which is provided by the third party, if both are not matching, if there is a difference between information which is there in the confirmation request or books of accounts, generally whatever information is there in the books of accounts, that only I include in the confirmation request. So whatever information which is there in the confirmation request and whatever response I am getting from the third party, if both are different, that scenario I call it as exception. For example, I am writing to my debtor, I'm asking him, sir, my client is telling that you are required to pay them 1 crore rupees of money. But the debtor, the third party, has given a response that, sir, I'm not required to pay 1 crore rupee, I'm required to pay 80 lakh rupees only. So there is a difference between information which is there in the confirmation request and response provided by the third party. This difference scenario only we call it as exception. Now I have one more question for you. Does an exception always mean a misstatement? If you find a difference here in the confirmation request, it is 1 crore. Response given by the third party is 80 lakh rupees. Will you automatically conclude that there is a misstatement? No, exception doesn't always mean a misstatement. Why? Because sometimes the differences could come even because of the mistake in the third party's books of accounts. Even because of mistake in the third party's books of accounts. So when you come across exception, you should not immediately jump to the conclusion that is a misstatement. Sometimes that could be a mistake in the third party's books of accounts also. So exception doesn't always mean a misstatement. Whether exception results in a misstatement or not, that as an auditor you have to investigate further and find it out. But whatever it is, the meaning of exception is there is a difference between the information which is there in the confirmation request and the response provided by the third party. That differential scenario we call it as exception, and exception doesn't always mean a misstatement. There is one more term which we need to understand here. There is one more definition which we need to understand here, which is non-response. We need to understand one more definition, which is what? Non-response. Let us try to understand that definition as well. So what is this non-response? Let us try to understand it. See, non-response means you are sending either a positive confirmation request or negative confirmation request, but it has been returned undelivered. It has been returned undelivered. Either you sent a positive confirmation request or you have sent a negative confirmation request, but it was unable to be delivered because the recipient is not found and it was returned undelivered back to you. This case we call it as non-response. There is one more case which will come under that non-response. You have sent a positive confirmation request. It was received by third party also, but the third party did not respond to you. This scenario also will come under non-response. So non-response includes two circumstances. You are sending a confirmation request, either positive or negative, and it has been returned undelivered. Or you are sending positive confirmation request, it has reached the third party, but the third party is not responding back to you. This also will come under non-response. Whereas if you send a negative confirmation request, if it is received by third party, but he is not giving response, can this be called as non-response? No, this is not called as non-response. Why? Because if you send a negative confirmation request, if it was received by third party and if it's not responding, it is an implied acceptance of the third party. This we can't call it as non-response. So non-response includes only two circumstances. You have sent a confirmation request, either positive or negative, but it has been returned undelivered. Or specifically you have sent a positive confirmation request, it was received by third party also, but is not giving response. This will come under non-response. Whereas the scenario where you sent a negative confirmation request, it was received by the third party, but if he is not responding, this can't be called as non-response, because there we assume that it has been accepted by the third party. Clear? So 5 definitions we have understood, very important from the examination perspective. So what are the 5 definitions we have understood? First, we basically got to know what is the meaning of external confirmation. Then we understood 2 types of confirmation requests, positive, negative. Then we understood the meaning of the term exception. Then also we have understood the meaning of the term non-response. Now coming to the procedure. See, if you want to get the best possible evidence from external confirmation, you need to maintain control over certain activities. Or if I put it in another way around, if you want to get the best possible evidence from external confirmation, you need to involve 4 steps. So in the exam, they can ask you a question in 2 ways. What are the steps which are required to be followed to obtain the best evidence from external confirmation? Or even they might ask you a question, what are the areas over which auditor needs to have control for external confirmation procedure? For both, answer is going to remain the same. So the 4 steps which auditor has to follow in order to obtain the best possible evidence from external confirmation is: number 1, you need to determine the information regarding which you want confirmation. Number 2, you have to select the appropriate confirming party. Number 3, you have to design your confirmation request. Number 4, once you have designed the confirmation request, you have to send it and do the follow-up. So what are the 4 steps if you want to get the best possible evidence from external confirmation? Number 1, you have to define the determine regarding which information you want external confirmation. Number 2, you have to select who is the appropriate confirming party to whom you have to send that confirmation request. Number 3, you have to design your confirmation request. Number 4, you have to send it and do the follow-up. Now let us try to talk about each and every step in a detailed manner. First one, determining the information to be confirmed. So regarding which information you want to get the confirmation, that you have to determine. Generally, we use external confirmation to obtain evidence regarding amounts and balances, like whether debtors balance is correct, creditors balance is correct, bank balances are correct or not, inventory balances are correct or not. So mainly we use external confirmation to obtain evidence regarding amounts and balances. But the use of external confirmation is not just restricted to amounts and balances. We can also use it for other than amounts and balances also. Like for example, if you want to get to know whether terms of the contract are correct or not, that also you can get it evidence by way of external confirmation. For example, if your client is telling the original documents are kept with the banker as a mortgage, you want to know whether really the banker is holding the original documents of the property. That also you can get to know about external confirmation. Your client is telling they have not given any discount. You want to know whether really your client has given a discount or not. That also you can get to know about external confirmation. So external confirmation, we don't deny it. We mainly use it for amounts and balances, but the use of external confirmation is not just restricted to amounts and balances. We can use it for other than amounts and balances also. So whatever it is, the first step is you have to determine regarding which information you want external confirmation. So once you have determined it, the next step is you have to select the appropriate confirming party. You have to send this confirmation request to appropriate confirming party. If you are sending the confirmation request to inappropriate party, the response will not be reliable. And in order to determine who is that appropriate confirming party, as an auditor, we have to take the help of management. Why? Because, for example, if you came to know your client is debtor, you will only come to know what is the name of the debtor's organization. In that debtor's organization, exactly to whom you have to send the confirmation request, you will not know it. Who will know it? Client will know it. So whatever it is, take the help of the client, determine the appropriate confirming party. Why? Because when you send the confirmation request to appropriate confirming party, then only responses will be reliable. If you are sending it to inappropriate party, even though you get the response, that will not be reliable. So that is the second step. So we determine the confirmation request, then we will determine the information, then we will select the appropriate confirming party. The third step is you have to design the confirmation request. So in designing of the confirmation request, various factors you have to consider. Sir, what factors I have to consider? You need to consider risk of material misstatement. See, if the risk is very high, I will go for positive confirmation request. I will try to stay away from negative confirmation request. So even you need to keep in mind the assertion regarding which item you are trying to obtain external confirmation. So depending on the item, for some items positive will be suitable, for some items negative will be suitable. So you have to pay attention to assertion. Presentation, that means either you have to send it in a paper form or you have to send it in an electronic form, that you have to decide. And also method of communication, once again, in what manner you want to communicate, that also you have to determine. Past experience, you have to use even your past experience also. If you have already worked with the client in the previous year, if you send either positive or negative, which will be more reliable, use your past experience as well. And even authorization, management authorization. Sometimes some third parties will say we will respond back to the auditor only when there is an approval from the management. In those circumstances, you have to get the approval of the management, then you have to send the confirmation request. So whatever it is, consider all these factors and finally design your confirmation request, either positive or negative, either paper or electronic form. So consider all these factors and design your confirmation request. See, once you have finally designed your confirmation request, what you will do? Keep it safely in your locker? No. Once you have designed the confirmation request, then you have to send it. And if you don't get the response within time, you have to do the follow-up. You tell me when we will generally do the follow-up. We will do the follow-up only in the case of positive confirmation request. We will not do the follow-up in the case of negative confirmation request. Why? Because in the negative confirmation request, if we don't get response, we will deem that the third party has accepted it. But in the case of positive confirmation request, if I am not getting the response on time, I will even send a follow-up also. Clear? So finally, after designing, you have to send the confirmation request and do the follow-up wherever appropriate, generally in the case of positive confirmation request. So these are the 4 areas over which the auditor needs to have control. He wants to obtain the best possible evidence. So what are the 4 areas? Number 1, determine the information. Number 2, select the appropriate confirming party. Number 3, design it. Number 4, send it and do the follow-up wherever appropriate. Now, few more parts of the standard are there, easy ones. Let us try to cover it. Next paragraph, use of negative confirmation request. See, as I have told, between positive versus negative, which confirmation request is more reliable? Positive. So generally, when compared with positive confirmation request, negative confirmation request will be less reliable. So the standard is telling, don't use only negative confirmation request when the risk is very, very high. Negative confirmation request will give less persuasive evidence. Negative confirmation request will give you less convincing evidence when compared with a positive confirmation request. So that's why you should not use negative confirmation request if the risk of material misstatement is very high. If you find in certain area the risk is very high, in that area don't use only negative confirmation request. In that areas either use positive confirmation request or use some other method. Don't use only negative confirmation request when the risk is very high. And the standard did not stop there. The standard is also telling you can use negative confirmation request as a only audit procedure in areas. In which areas you can use negative confirmation request, that areas also standard is listing out. So in which areas you can use negative confirmation as a sole substantive procedure. That means where you can rely only on negative confirmation request. In which kind of areas you can use only negative confirmation request. Common sense, basically wherever risk is very low, in those areas where the controls are very effective. In case of small and homogeneous population, small items which doesn't matter, which are very immaterial, there also use negative confirmation request. Where low exception rate is expected, that means you are finding in certain area the chances for differences are very low. In that areas also you can send confirmation, negative confirmation, when the recipient doesn't disregard your request. This means, for example, you know the third party very well, that the third party will go through each and every confirmation request. If he finds something wrong, he will definitely respond. If you know that third party very well, then also you can use a negative confirmation request. So it will be better for you if you use negative confirmation request only in those areas. In other areas, it is always advisable to go with positive confirmation request. Why? Because negative confirmation request will give you less convincing audit evidence. Clear? Then two more things are there. Management's refusal to send a confirmation request. See, as an auditor, you want to send a confirmation request to the third party, but the management is refusing. Management is not allowing you to send the confirmation request to the third party. In those circumstances, what you should do? The standard says if the management is refusing the auditor to communicate with the third party, first inquire the reasons. Ask the management because of what reasons they are asking me not to communicate with the third party. If there is a reasonable justification, if they are able to give me valid reasons, then what I will do? I will try to perform alternative audit procedure. Sir, what could be alternative audit procedure? Once again, as I have told, is up to your professional judgment. So if the management is coming to me and telling me, sir, don't communicate with the third party, don't communicate with the debtor, I should first ask them reason. Sir, why are you asking me not to communicate with the debtor? Now, sometimes management will give valid reasons, like the management is telling, sir, that we are recently had an issue with the debtor. He is very much worried about us. He is very much having a grudge on us. So even if you ask a confirmation request intentionally to mislead you, he will give wrong information only. So management gave reasons. I found it is reasonable. Then what you should do? Then what you should do is try to perform alternative audit procedures. Apply your mind. Think what alternatively you can do to obtain audit evidence. If not possible, sir, if alternative audit procedures are also not possible, then what I should do? First, communicate with those charged with governance and even consider modifying your opinion. Here also generally either qualified or disclaimer. Why? Because it is a non-availability of audit evidence. So the management refuses, there is a reasonable justification, perform alternative audit procedures. If not possible, communicate with those charged with governance and even consider modifying opinion. Sir, what if there is no reasonable justification? Management is not giving me any valid reason. I want to communicate with the third party. Management told no. I am asking them reasons. Sir, why you don't want me to communicate with the third party? The management is giving all the bullshit reasons, or they're not giving me any reasons at all. Then what I should do? Here the standard says you have to reassess the risk of material misstatement. Why? Because now you got to know the true nature of management. Earlier you thought management was honest. Now you got to know about the true nature of the management. Earlier you might have thought risk is very low. Now you have to change your risk of material misstatement. Particularly analyze is there any risk of fraud and make changes to your nature, timing and extent of audit procedures. So if the management did not give you valid reasons, you have to reassess the risk of material misstatement once and make suitable changes to your audit procedures. Here also communicate with those charged with governance, and if you feel necessary, even you consider modifying your opinion. Clear? So this is what SA 505 says regarding external confirmation. Very simple, guys. What we have understood in the standard, what is the meaning of external confirmation? Two types of external confirmation: definition of non-response, definition of exception. Then we have seen in the process of obtaining evidence from external confirmation procedure, what steps you have to follow. 4 steps are there, that also we have seen. Then we have seen in which specific circumstances you can make use of negative confirmation request. What if the management refuses you to send the confirmation request? Clear, everybody? So with this, we are successfully done with SA 505 as well. Hope you guys are able to understand it. So since we are done with revising the standard SA 505, now we will try to discuss the next standard, which is almost similar to SA 505. So we will take up the standard now for discussion, which is SA 580. Which is SA 580, very simple one. It will look mostly like SA 505 itself. So we will revise now SA 580. So what does SA 580 talk about? As you could see the title of SA 580, it is going to talk about something called written representation. It is going to talk about something called written representation. So nothing but in this standard, we are going to revise what is the meaning of written representation, how it can be used as audit evidence, regarding which matters auditor is required to obtain written representation. So all these things we are going to focus in this particular standard. So without any delay further, let us try to revise the concepts of SA 580. So first I will try to begin with what is the meaning of written representation. First we will try to understand what is the meaning of written representation. Guys, if you just go back to the discussion whatever we had just now, we understood SA 505, in that we have understood what is the meaning of external confirmation, right? So what is the meaning of external confirmation? External confirmation is a direct written response obtained by the auditor from a third party, that we call it as what? External confirmation. Now written representation means it is a direct written statement obtained by the auditor only, but not from the outsider, from the management, that we call it as written representation. External confirmation is a written confirmation obtained by the auditor from a third party. Whereas if the auditor is trying to obtain that written confirmation from the people who are inside of the organization, particularly management, so then it becomes an written representation. So that is what the meaning of written representation, nothing but a written statement which is obtained by the auditor from the management of the organization to confirm certain matters or to support the other audit evidences whatever he is having. So nothing but whatever confirmation which auditor is obtaining from the management of the organization to confirm certain matters or to support the evidences whatever he is having, that's written statements obtained by the auditor from the management, we are going to call it as written representation. Like for example, in SA 501, if you remember, I told as an auditor, when you are trying to obtain audit evidence regarding litigations and claims, you need to obtain the written representation. So if you remember that particular discussion, if you go back to SA 501, so in the SA 501, when we are understanding how to obtain audit evidence regarding litigations and claims, one of the audit procedures they have told is auditor should obtain written representation regarding litigations and claims. So that means as an auditor, you will ask the management to give a confirmation that the management has disclosed all the litigations and claims and they have provided the complete information to the auditor regarding litigations and claims. So basically, if you pay attention here, what auditor is trying to do is trying to get a written confirmation from the management to confirm certain matters or to support the other audit evidences. So that written statements obtained by the auditor, that we call it as written representation. Now the question is, can the written representation be used as audit evidence? Can the written representation be considered as audit evidence? For example, if I ask the management to give a confirmation regarding certain matter, so management gave me a confirmation, take litigations and claims only. I asked the management to give a written confirmation that they have disclosed all the litigations and claims. They gave me a written representation. Can I consider it as evidence? Can the written representation be used as audit evidence? The answer is yes. Written representation is a kind of audit evidence, but the problem is written representation cannot be considered as evidence on its own, which simply means that you should not use written representation only as a audit evidence. It is just a supporting audit evidence. Written representation is what? It is just a supporting audit evidence. You can't consider written representation as a evidence on its own. Sir, why the standard has specifically told this? Why? Because if the standard has given a permission, written representation alone can be used as audit evidence, my audit becomes very simple. See, what I will do is, written representation alone can be used as audit evidence. I will accept appointment of audit of certain entity. I will go to that entity. I will ask the management to give two simple confirmation. Sir, give me a confirmation that you have prepared the financial statements as per applicable financial reporting framework. Give me a written confirmation that you have prepared the financial statements free from material misstatements. I will get the two confirmations, express my opinion, my audit will be over. So do you think that is appropriate? No, that's what even the standard says. You can use written representation only as a supporting evidence. You can't use the written representation as a audit evidence on its own. Clear? So very, very important. So we understood what is the meaning of the written representation, how written representation can be used as audit evidence. Now let us try to understand what are the objectives of the auditor as per SA 580. Or they might also ask you a question regarding which matters auditor is required to obtain written representation. So if they ask you the question, what are the matters regarding which auditor need to obtain written representation, or if they ask you the question, what are the objectives of the auditor as per SA 580, for both the questions we are going to write the same answer. So let us try to understand regarding which matters auditor need to obtain written representation. So the auditor must compulsorily obtain in every audit engagement, the auditor must obtain written representation regarding two things compulsory. What are they? that the management has fulfilled the responsibility for the preparation of financial statements. So whenever you are conducting audit of any entity, you must obtain one written confirmation from the management that they are agreeing to fulfill their responsibility for the preparation of financial statements. Number two, you should also obtain written representation from the management that there is a completeness of information provided to the auditor. So if you are conducting audit of any entity, the first thing which you need to do is you should go to the management and say, sir, please give me a written confirmation that you will fulfill your responsibility for preparation of financial statements, that too as per applicable financial reporting framework. Not just that, you also ask the management to give a written confirmation that they have completely provided the information to the auditor. They did not hide any information from the auditor. So these are two matters. Regarding these two matters, preparation of financial statements, completeness of information provided to the auditor. Regarding these two matters, the auditor first should go and obtain written representation compulsorily in every kind of audit. And not just that, if there is any requirement of any relevant standard, if any standard is asking the auditor to obtain written representation regarding certain matter, there also it is mandatory. Like for example, just now as I have told, SA 501 is asking the auditor to obtain written representation regarding litigations and claims. Since SA 501 is telling it, it is mandatory for the auditor to obtain the written representation. Able to understand what I'm trying to say here? So these are three matters. So practically three matters. Regarding these three matters, the auditor must obtain written representation that the management will fulfill the responsibility. They will provide completely the information to the auditor, and if there is any requirement of the standard in that regarding that matter also, auditor must obtain compulsory. In remaining all the circumstances, it is up to the auditor's choice for which matter he wants written representation, for which matter he doesn't want written representation. In rest of the matters, auditor can decide. And whatever representations which have been provided by the management, you have to respond to that appropriately. In some cases, you will ask the written representation, but the management will not provide it. Then also you have to respond appropriately. Sir, how to respond appropriately? That's what we are going to see in the remaining part of the standard. So these are the objectives. Regarding three matters, you need to obtain compulsory representation, and if the management has given you required written representation, you have to respond to that appropriately. If the management did not give you the requested written representation, then also you have certain responsibilities to fulfill. What are they? We are going to talk about it. Clear? Next, date and period covered by the written representation. One of the most important thing, guys, particularly important for true or false statements. So what is that thing is, between date of written representation and date of auditor's report, which one should be earlier, which one should be later? Between date of written representation and the date of auditor's report, which date should be earlier? The standard says that the date of written representation should not be later than the date of auditor's report. That means the date of written representation should be on or before the date of auditor's report. The date of written representation can't go beyond the date of auditor's report. Very, very important from the true or false statements perspective. The logic is very simple, guys. Written representation is an audit evidence. So the logic of the audit is, first we try to obtain audit evidence, then we express our opinion. So that's why the date of written representation should always be earlier or on the date of auditor's report. It should never be later than the auditor's report date. Clear? So that is what the date and period covered by the written representations. Next, sir, from whom you are going to request written representation? As I have told, management. So generally we go and request a written representation from the management, and particularly we go and request written representation from that part of the management who are having a knowledge about the preparation of the financial statements. Like we generally go and ask the written representation from CEO, CFO, board of directors, audit committee. So from these people, we expect that these people will have required information regarding the financial statements. So generally from this part of the management, we will ask the written representation. But sometimes what will happen is, when we go to the management, for example, you go to the CFO and say, sir, I want a written representation regarding litigations and claims. CFO is telling that, sir, I am not the appropriate person. Why? Because there is a dedicated legal team inside the organization. That team will look after the legal litigations and claims. Since I don't have information, I will not provide written representation. Can the CFO escape by saying this? No. So what the standard says is, if you want written representation, you will go into the management and ask. If the management is having the information, they will give you. If the management does not have the requested information, they have to, it is a responsibility of the management to go to the concerned person in the organization, get the required information, then provide the confirmation to the auditor. The management simply can't escape saying, sir, whatever representation you are asking for, regarding that we don't have information, we will not provide written representation. Management can't escape saying this. So if the management is not having the required information, what they have to do? They have to go and inquire others within the organization from whom they will get the relevant information, and the management should get that information from that concerned persons in the organization and then provide written representation to the auditor. They can't simply escape saying they don't have the relevant information. Sir, generally with whom the management will go and inquire. So generally, for example, if as an auditor, I am asking some written representation regarding provision, but management doesn't know it. There is a dedicated actuary. So then what management should do? Go to the actuary, get the information, provide the written representation to the auditor. Or it could be legal expert. Like for example, I am asking written representation regarding litigations and claims, but management is not having it. Legal team is having it. Go to the legal team, get the information, then provide the written representation to auditor. Or it even could be a staff engineer. So like this, if the management does not have requested information, inquire others, get the relevant information, then provide the written representation to the auditor. So what and all we have covered till now in the standard? We have covered what is the meaning of written representation, how written representation can be used as audit evidence, what are the objectives of the auditor as per SA 580, for what is the date and period covered by the written representation, and from whom you are generally going to request a written representation. Now, next, one more paragraph, important paragraph. When the auditor has to obtain written representation from the management to reconfirm its responsibilities. See, generally at the beginning of the audit, we obtain written representation that the management will fulfill their responsibilities. But in some cases, what will happen is, once again, you have to obtain written representation from the management to reconfirm its responsibilities. In what circumstances? Generally, at the beginning of the audit, we obtain written representation from the written representation from the management that they will fulfill all the responsibility for preparation of financial statements and all. But in some circumstances, what will happen is, once again, even though you have obtained written representation at the beginning, once again, you might be required to ask the management to give the representation once again to reconfirm the responsibilities. Sir, in what circumstances? Very simple. When who signed the terms of engagement have changed. At the beginning, some board of directors have signed the written representation and gave it to me. But later what happened is, board of directors have changed. So now new board of directors are there, new management is there. So it will be better if you get the written representation once again from this new management to reconfirm their responsibilities. Or terms of engagement are prepared in the previous year. You have prepared the terms of engagement in the last year. In the current year, there are some changes in the terms and conditions. Once again, ask the management to reconfirm their responsibilities. Or even it could be management misunderstand its responsibilities. Initially, when they gave the written representation, they misunderstood their responsibilities. Now they realized it. To sort out that misunderstandings, once again ask them to give a written representation to reconfirm their responsibilities. Or even sometimes there could be change in circumstances. In those cases also, we can ask the management to reconfirm their responsibilities using written representation. So 4 circumstances they have told. Number 1, who signed the terms of engagement have changed, and the terms of engagement are actually prepared in the previous year, or we have an indication that management misunderstood their responsibilities, or there could be change in the circumstances. Clear, everyone? Now, coming to the next paragraph, what if you get doubt regarding reliability of written representation? So you asked the management to give the written representation, and in fact, management has given it. But you are getting doubt. Whatever written representation given by the management, whether it is reliable or not, you are having a doubt. Generally, when we get that doubt, management gave you written representation, management gave a written statement, but sometimes you will get that doubt. In what circumstances generally we get that doubt regarding reliability of reliability of written representation? When we came to know that management are not having integrity. That means management are not honest people, management are not genuine people, they are known for committing frauds. In those circumstances, you should generally get a doubt regarding reliability of written representation. Yes or no? So that's what they say. When you generally get the doubt regarding reliability of written representation is when you have concerns about integrity, competence, and ethical values. That means you came to know that management is not honest, management is not capable, management is not having ethical values. In those circumstances, even though they have given the written representations to you, but you will not be in a position to rely on it. Then what you should do? Is if you are having doubt regarding reliability of written representation, you should compare written representation with other evidences, whatever you have gathered. I told written representation is only a supporting evidence, no? So when you have doubt regarding written representations, reliability, you match the written representation with other evidences and try to find out whether written representations are correct or management is giving wrong written representation. That you have to do. So you have to match written representation with other evidences. If they are matching, well and good. In that cases, you can rely. In some cases, what will happen is when you had a doubt, you compared the written representation with other evidences and you found they are inconsistent. That means management is trying to say something in the written representation, but actually my evidences are telling something else. So in case if the written representations are inconsistent, they are not matching with other evidences, then the auditor should dig deeper and analyze whether written representations are wrong or your evidences are wrong. Sometimes what could happen is you could have done mistake in the audit procedures. That's why your audit evidence could be wrong. So when the written representations are inconsistent with other evidences, you have to take one more step ahead and find out whether written representations are wrong and audit evidences are wrong. If audit evidences are only wrong, then we can obtain the new evidences. But if you have decided that no, written representations are only wrong, by comparing, by digging deeper, you realize that no, my evidences are correct only, written representations are only not reliable, then the auditor shall even consider modifying the opinion. If you have finally decided that written representations are not reliable, you have to modify the opinion. Generally in these circumstances, you have to give disclaimer of opinion. The standard SA 580 told, if you decided that written representations are not reliable, directly give a disclaimer of opinion. And in some cases, what will happen is you are asking the written representation, but the management is not providing it. See, in the previous case, you asked for a written representation, management provided it, but they are not reliable. But in some cases, what will happen is you are asking for the written representations, management is not even giving that written representation. Then what you should do? So in case if the management is not giving the written representation, number one, go and discuss the matter with the management. Why they are not giving the written representation? Go and question them. Re-evaluate the integrity, reassess the integrity of the management. Nothing but you have to reassess the risk of material misstatement. Why? Because you got to know about the true nature of the management now. Same way as we have done in SA 505. So reassess the integrity of the management, and if appropriate, even consider modifying the opinion also. So in case if the requested written representations are not provided, this is what you are supposed to do. Clear, everybody? Able to understand? Comfortable, everybody? So this is what SA 580. So how many standards we have revised till now? 3 standards we have revised in SA 500 series. 501 we are done, 505 we are done, 580 also we are done. Everybody comfortable till here? Able to follow? So now we will try to revise SA 510. So we are done with 3 standards. So one more standard we'll try to revise from 500 series. So SA 510 we will try to revise it. So what does SA 510 talk about? So once again, very simple standard, guys, very important also from the examination perspective. So SA 510 is going to talk about initial audit engagements and opening balances. What is the title of SA 510? The title of SA 510 is Initial Audit Engagements and Opening Balances. Sir, what does this standard So what does this standard talk about? See, before we try to go into what does this standard talk about, first let us try to revise the meanings of the term. What is the meaning of the term initial audit engagement and what is the meaning of the term opening balances? So first we will try to understand what is the definition of the term initial audit engagement. Very simple, guys. See, if the last year auditor is only appointed as current year auditor, that we call it as recurring audit. This point I have already clarified when we discussed the chapter nature, objective and scope of audit. If the last year auditor is appointed as current year auditor, we call it as a recurring audit. Then what is the meaning? What is the meaning of initial audit engagement? Simply, if the last year auditor and the current year auditor both are different firms or different individuals, then we call it as, then for the current year it becomes an initial audit engagement. Simply, if the last year auditor and the current year auditor both are different, we call that assignments as initial audit engagements. Clear? This is a simple meaning. But for this term initial audit engagement, they have given a definition in the standard. So what definition has been given? So they have defined initial audit engagement as the engagement in which the prior periods were either unaudited, that means last year audit itself did not happen, or the prior period financial statements were audited but by a predecessor auditor. A different audit firm, a different auditor has conducted the audit of the previous year who is different from the current year's auditor, then also we call it as an initial audit engagement. So nothing but if I put it in simple terms, if the last year auditor and the current year auditor are different persons, then we call the current year audit as initial audit engagement. That only they are giving a technical definition in a very bit, they have made a bit complicated. So they define the term initial audit engagement as those audit engagements in which either the prior periods were unaudited, last year audit itself did not happen, or prior period financial statements were audited but by some predecessor auditor, different person has done the audit of the previous year. So that is what the meaning of initial audit engagement. Now one more term which they are using in the title is opening balances. Sir, let us try to understand what is the meaning of the term opening balances. So opening balances, we already know the meaning. What is the meaning of opening balances? Those balances which are there at the beginning of the period. And these opening balances are nothing but which are taken from the last year's closing balances. So opening balances are balances which are existing at the beginning of the period, and these opening balances are actually derived from last year's closing balances. And one important thing we have to remember, when I say opening balances just doesn't mean only the items which are there in the balance sheet. Even the items which are disclosed in the notes to accounts of the last year's financial statements also becomes current year's opening balances. Very, very important. This they might ask you in the true or false statements. When I say opening balances doesn't include only balance sheet items. Even it includes the items which are disclosed by way of notes to accounts. For example, the current year is 23-24. In the last year 22-23 financial statements, in that financial statements notes to account, they have shown some contingent liabilities worth 100 crores. Even this item which is in the notes to accounts also becomes a opening balance for the current year. So opening balances just doesn't include only balance sheet items, it includes even the items which are included in the notes to accounts. So we understood the meaning of the two terms which they have used in the title: initial audit engagement, opening balances. Now, what is the objective of the standard? Why this standard has been given, or what the standard talks about? Very simple, guys. See, take for example, if you have been appointed as auditor of the financial year 2022-23, so you are conducting audit of this financial year. There is no doubt, if you are appointed as auditor of the financial year 2022-23, there is no doubt that whatever transactions which have taken place from 1/4/2022 till 31st of March 2023, the transaction taken place during this year, you will verify. There is no doubt about it. And not just that, you will also verify the balances which are existing as on 31st of March 2023. So if you have been appointed as auditor of a financial year, you will try to verify all the transactions which have taken place during the year, and also you will try to verify the balances which are existing as on the balance sheet date also. But my doubt is, if you are appointed as auditor of this financial year 2022-23, is there any responsibility to verify the opening balances also? Is there any responsibility for you to verify the opening balances also? The answer is yes. Yes, that's what even the standard says. And the standard says that particularly in initial audit engagements, in which kind of engagements, than when compared with the recurring audits, particularly in the case of initial audit engagements, the auditor should even try to obtain audit evidence regarding opening balances also. Why? Because if the opening balances contain a misstatement, then it is definitely going to impact the current year's closing balances, which is going to have an impact on the current year's financial statements. So that's why the standard is telling, particularly in the case of initial audit engagements, as an auditor, you are required to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement that could affect my current period's financial statements also. So you have to obtain the audit evidence. One of the objective is this. There is one more objective. This I will come to that later. First, we will focus on the first objective. So one objective with which the standard is given: if you are conducting initial audit engagements, it is your responsibility to obtain sufficient and appropriate audit evidence whether opening balances contain a misstatement which could affect the current year's financial statements. That you need to obtain audit evidence. As we know, if we want to obtain audit evidence, we need to perform audit procedures. So the standard is telling in the objective that you need to obtain audit evidence whether opening balances contain a misstatement. But how can I obtain that audit evidence? So by performing some audit procedures. So what audit procedure auditor is required to perform regarding the opening balances? Let us try to have a quick look at it. So what audit procedures are required to be performed regarding the opening balances to obtain audit evidence? Number one, first thing they are telling, as an auditor, if the last year financial statements are audited, read the most recent copies of the financial statements. Nothing but immediately preceding financial year financial statements, whatever are there, get that copy of the financial statements and read it. Number two, determine whether prior period closing balances were correctly brought forward. Whatever last year's closing balances are there, whether they are correctly brought forward in the current year as opening balances, that we need to verify. Any adjustments relating to prior period have been shown as prior period items. In the current year, if you find any error which is related to the previous year, that should be shown separately in the statement of P&L as a prior period item. That also you have to verify. And whether opening balances reflect the application of appropriate accounting policies. Nothing but whatever accounting policies which are reflected in the opening balances, that opening balances, what that accounting policies in the opening balances, are they appropriate? Guys, one more thing here. See, when I say opening balances generally reflect two kinds of information. Opening balances reflect the effect of the transactions which have taken place during the previous year, and opening balance also reflect whatever accounting policies which are followed in the previous year. For example, if I came to know that the opening balance of plant and machinery is 1 crore rupees, what is this 1 crore representing? This 1 crore is reflecting the effect of all the transactions taken place in the previous year. It is also reflecting what accounting policies, like what depreciation policy has been followed. So opening balances will even reflect accounting policies. We need to check whatever accounting policies which are reflected in the opening balances, whether they are appropriate or not. Like for example, I came to know that for charging depreciation, the last year client followed SLM method. When SLM method will be appropriate? When the consumption pattern of the machinery is going to be uniform. So like that, I have to judge. So whatever accounting policies reflected in the opening balances are there, whether they are appropriate or not. And you should perform specific audit procedures like comparing the opening trial balance with the last year's audited balance sheet. You have to download from the accounting software opening trial balance, take the last year's audited financial statements, try to match both the balances. So like this, if you perform these procedures, you will come to know whether opening balances contain a material misstatement. Clear? Guys, what we have seen till now in this standard, we understood what is the meaning of initial audit engagement. We understood what is the meaning of opening balances. We understood one of the objective of the standard, that is to obtain audit evidence regarding opening balances, whether they contain a misstatement. And in order to obtain that audit evidence, what audit procedure auditor has to perform, that audit procedures also we have seen. So now by performing these audit procedures, you will obtain audit evidence. You will have findings. What findings will be there? See, if you came to know that opening balances are all correctly brought forward, there is no misstatement in the opening balances. Is there any impact on the current year's audit? No. That is a favorable scenario. If you performed all these audit procedures and you came to know that opening balances do not have any misstatement, that means it's a good scenario. Nothing impact on your audit procedures or audit opinion. When the problem will happen? So when the problem will happen is, if you performed audit procedures and if you have obtained sufficient and appropriate audit evidence that opening balances are containing a material misstatement. That means by performing the above audit procedures, you came to know that yes, opening balances contain a material misstatement which could affect my current year's financial statements. Then what you should do? You have to give a modified opinion. Sir, what kind of modification? You have to give either a qualified opinion or adverse. Why, sir? Why? Because I'm telling here, auditor is able to obtain sufficient and appropriate audit evidence. Since he is able to obtain sufficient and appropriate audit evidence and concluded that opening balances contain a material misstatement in the current year's financial statements also, you have to modify the opinion. And since you have evidence here, either you have to give qualified or adverse. Or in some circumstances, what could be possible is auditor is not in a position to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement, whether opening balances contain a material misstatement or not, that you are unable to obtain audit evidence only. Then what you should do here also, you have to modify the opinion. What kind of modification here? Since it is a case of non-availability of audit evidence, you have to give either qualified or disclaimer. Clear? So this is how your audit opinion will have an impact based on whatever findings you have relating to opening balances. Understood, everybody? Now talking about the second objective. See, till now I discussed only one objective of the standard SA 510. There is one more objective. See, when I say opening balances, just now as I have told, opening balances also reflect accounting policies, whatever has been followed in the previous year. Now when it comes to accounting policies, there is one fundamental accounting assumption. There is one fundamental accounting assumption associated with accounting policies. What is that fundamental accounting assumption? Consistency. So since opening balances are reflecting accounting policies also, as an auditor, you need to even obtain audit evidence. That is, there is one more objective of SA 510. So SA 510 also says that you are required to obtain sufficient and appropriate audit evidence whether accounting policies, whatever reflected in the opening balances are there, whether they have been consistently applied in the current year. Whatever opening balances are, whatever accounting policies are there which are reflected in the opening balances, they should have been consistently applied in the current year. That means without any valid reason they should not be changed. And if at all there is a change because of valid reason, see, in some cases accounting standards will permit you to deviate from the consistency when there is a valid reason. So if at all there is a valid reason for change in the accounting policy, that change should have been appropriately disclosed. So here two things are there regarding accounting policies. Number one, as an auditor, you need to obtain sufficient and appropriate audit evidence. Without any valid reason, there should not be change in accounting policy. That means consistency should be there. Sometimes there will be a valid reason and it will be even permitted by the standards to change the accounting policy. In such circumstances, we need to see that the change should have been appropriately disclosed. You have to be very careful, guys. Two things I have told. Without any valid reason, you should not change accounting policy. Number two, if there is a valid reason for change in accounting policy, that change should be appropriately presented and disclosed in the financial statements. So like this, regarding these two things, you even need to obtain audit evidence. So that is one more objective. So that's why we have two objectives for SA 510. Number one, whether opening balances contain a misstatement which affect the current year's financial statements. Number two, whether accounting policies are consistently applied. If at all there is a valid reason for change in the accounting policy, whether it has been appropriately and properly presented and disclosed as per the applicable accounting standard. Clear till here? So now when it comes to this accounting policies, so what is your object? What is our objective? We have got to know. So now how audit report will be impacted because of accounting policies. See, if the auditor concludes, that means after he tries to verify the accounting policies consistency and all, if the auditor concludes, that means if the auditor has obtained audit evidence that either accounting policies are not consistently applied, that means there is no valid reason, without any valid reason the client has changed the accounting policies, that means they have violated the consistency even without any valid reason, or there is a valid reason for change in the accounting policy but it is not properly presented or disclosed in the financial statements. If you have verified the accounting policies and you have concluded that you have obtained audit evidence that either without any valid reason consistency has been violated, that means the change in accounting policy has taken place even though there is no valid reason, or there is a valid reason, that's why the management has changed the accounting policy but they did not properly disclose that change in accounting policy, then what we should do? Then the auditor should modify the opinion. Sir, what kind of modification? Either a qualified opinion or an adverse opinion. Why? Because I am telling the auditor has concluded, the auditor has obtained audit evidence that without any valid reason either accounting policy has been changed or there is a valid reason for change in accounting policy but that change is not properly presented or disclosed in the financial statements. In any of these circumstances you have to give either a qualified opinion or adverse opinion depending on materiality and pervasiveness. If the effect is only material but not pervasive, qualified. If the effect is material and also pervasive, adverse. Clear? So this is how audit report will be impacted because of accounting policies. So if you see here, majority of the standard we have covered. So now we are successfully done with definitions, the complete two objectives, what audit procedures has to perform, what impact auditor's opinion will have with regard to findings in the opening balances, what impact auditor's opinion will have with regard to findings in the accounting policies. There is even one more last point in this standard, once again important from the examination perspective. Sir, what if there is a modification in the predecessor auditor's report? That means, for example, if you are doing audit of the year 23-24 of some entity, last year some other auditor has done the audit. Now, the last year auditor on the last year's financial statements, he has given a modified opinion. Last year auditor on the last year's financial statements, he has given a modified opinion. That modification could be either qualified, adverse, disclaimer. Just because last year's auditor has given a modified opinion, is there a mandatory requirement on the current year's auditor to also give modified opinion? No. So just because last year's auditor has given a modified opinion, there is no requirement or there is no mandatory requirement on the current year's auditor also to give modified opinion. So when the current year auditor also will give modified opinion is because of whatever reason the last year's auditor gave modified opinion. If that reason remains relevant, unrectified and material for the current year, then only the current year auditor also will give modified opinion. Yes or no? If because of whatever reason the last year's auditor gave modified opinion, it is no longer relevant for the current year. If it is no longer material for the current year, if it is no longer relevant for the current year, then there is no requirement on the current year auditor to modify just because of a simple reason that last year auditor contained a modified opinion. Clear? The same thing they try to say here. If the reason for modification in the predecessor's auditor's report, because of whatever reason the last year auditor gave the modified opinion, that remains relevant and also material for the current year financial statements, then only the current year auditor will express modified opinion. Which means if because of whatever reason the last year auditor gave the modified opinion, if it is no longer relevant and material for the current year, then there is no mandatory obligation on the current year auditor to compulsorily issue modify. There is no mandatory obligation. Only when the reason because of which the last year auditor gave a modified opinion, if it remains relevant and material for the current year, then only he will modify. Clear? So this is what simply SA 510 talks about. I hope these standards are helping you out. So till now, how many standards we have done? Four standards we have done: 501, 505, 580 and 510. So 4 standards from the SA 500 series we are actually done with. Clear and comfortable till here? So now I will take up for revision SA 560 we will try to revise. So which standard we will try to revise? SA 560 we will try to revise. So SA 560 is a standard which is talking about subsequent events. So just let me take you there. Yes, here we have. So we will try to understand now SA 560 dealing about subsequent events. So first of all, let us try to understand what is the meaning of this term subsequent events. What exactly does this standard deal about? What are auditors' responsibilities? What audit procedures auditor has to perform? So like the way we have covered the concept in the previous standards, we will try to cover even the concept from SA 560 as well. So what is the meaning of subsequent events? See, in the accounting standards also, you might have heard about the subsequent events. In the accounting standards also, you might have heard about subsequent events. So what you might have heard about subsequent events as per accounting standards? So they say that those events which are occurring between the date of financial statements and the date of approval of the financial statements, those events we are going to call it as subsequent events. This definition is as per accounting standard. So first we will try to recollect what we know regarding subsequent events as from the perspective of accounts. Then we will try to come to standards on audit. So first I am taking you back to the accounting concepts. So as per the accounting standards, subsequent event means those events which are occurring between the date of financial statements and the date of approval of the financial statements. And from the accounting standards perspective, subsequent events can be divided into two categories. Number one is adjusting events. Number two is non-adjusting events. Sir, what are adjusting events? Those events which conform to the conditions existing as on the balance sheet date. Whereas non-adjusting events are those events which conform to the conditions which are existing after the balance sheet date. And depending on whether an event is adjusting event or non-adjusting events, its accounting treatment also will change. So when it is an adjusting event, it will be adjusted in the financial statements itself. Whereas if it is a non-adjusting event, we will try to just to show it by way of notes, by way of disclosures. So no, so this is what we know regarding subsequent events as per accounting standards. So basically accounting standards talks about what is management's responsibility with regard to subsequent events in the preparation of the financial statements. So that's what accounting standards will talk about. No, accounting standards will talk about what are management's responsibilities in the preparation of the financial statements. But when I say standard on audit, standards on auditing has nothing to do with the management responsibilities. Standards on audit are the documents which are governing what will be the responsibilities of the auditor while conducting the audit of the financial statements. So I hope this point is everybody clear with. So accounting standards, whatever you have seen in the accounting subject, those accounting standards will actually talk about management's responsibilities in the preparation of financial statements. Whereas accounting standards are going to talk about auditors' responsibilities while conducting the audit of the financial statements. So in this standard SA 560, we are going to talk about what is the responsibility of the auditor while conducting the audit if he comes to know about any subsequent event. Clear? So first of all, what is the meaning of the subsequent event as per SA 560? So SA 560 defines the term subsequent event as those events which are occurring between the date of financial statements and the date of auditor's report, and the fact came to auditor after the date of auditor's report. Those events will be called as subsequent events. Confusing? Let me try to give a simple example to make you understand this. So what they are telling? There are events as per accounting standard, as per standard on audit 560, subsequent events or those events which are occurring between the date of financial statements and the date of auditor's report. Take for example 23-24 financial year. So when it comes to 23-24 financial year, the date of financial statements will be 31st of March 2024. Assume that generally what will happen is first date of balance sheet will be there, then the financial statements will be prepared, then the financial statements will be approved. So once the financial statements are approved, then they will be audited by the auditor, and the date the auditor will mention in the auditor's report, that will be the date of auditor's report. Assume that audit got completed somewhere around 15th of May 2024. So some event has taken place between these dates. That is from between 1st of April and 15th of May, some event has taken place, but the happening of that event that came to the auditor's knowledge after the date of auditor's report, those events we are going to call it as subsequent events. Very, very important definition, guys. Those events which are happening between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge when event has taken place during this time only, but the information regarding that event came to auditor's knowledge after the date of auditor's report. Only those events we are going to call it as subsequent events. So here you have to remember one important thing. See, if some event has taken place here, and if the auditor came to know about this even before the date of auditor's report only, then there is no need of any standard. Then the auditor need not have any guidance. Why? Because if the auditor came to know about any event before the date of auditor's report only, then whatever action he wants to take, that he will take it through his own audit report. When the problem will arise, when you have already signed the audit report, then you came to know about the event, then you start looking for the guidance. Able to understand? So that's why the events which have taken place between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report, those events only we call it as subsequent events. If the auditor came to know about it prior to the date of auditor's report, we don't have any guidance, we don't look for any guidance. Why? Because since audit report is not yet given, whatever action he wants to take, the auditor will take the action through his audit report only. Clear, everybody? So that is what the meaning of subsequent events. Clear? Now, let us try to understand further what are the auditor's responsibilities regarding that subsequent events. See, before I talk about auditor's responsibility regarding subsequent events, we need to understand certain dates. Meaning of certain dates we have to understand. Number one, date of financial statements. Date of financial statements means nothing but date of the balance sheet date. The last day of the financial year, we call it as date of financial statements. Next, date of approval of financial statements. The date of approval of financial statement means the date on which those with responsible authority, like board of directors, accept the responsibility for the financial statements. The date on which the concerned people in the organization take the responsibility for the financial statements, that date we call it as date of approval of the financial statements. Nothing but that, if I have to put it in simple terms, the date on which board of directors sign the financial statements, that I call it as date of approval of the financial statements. Then we have date of auditor's report. As I've already told you, the date which the auditor is mentioning in his audit report, that we call it as date of auditor's report. See, one important question I would like to ask here: between the date of approval of financial statements and the date of auditor's report, which one should be later? So if I put it in other way around, the date of approval of financial statements should never be later than the date of auditor's report. The date of approval of financial statements should never be later than the date of auditor's report. It should be either on or before the date of auditor's report. The date of approval of financial statement should never go beyond the date of auditor's report. Clear? And one more date we have to remember here: date of issue of financial statements. Very important. There is a test your knowledge question in the new study material regarding this particular question. What is the date of issue of the financial statements? The date of issue of financial statement means the date on which the financial statements are made available to third parties. The date on which financial statements are made available to third parties. When I say third party, other than auditor and management, the date on which the financial statements are made available to third parties other than auditor and management, that date we call it as date of issue of financial statements. Now, date of issue of financial statements can be depending on facts and circumstances. For example, the date of issue of financial statements could be the date on which the management has uploaded their audited financial statements in their official website. Or the date of issue of financial statements could be the date on which the mail containing the audited financial statements has been forwarded to each and every shareholder. Or the date on which the date of issue of financial statements could be the date on which the audited financial statements are shared with the stock exchanges. So whichever is earlier out of all these dates, the first time when the financial statements are brought before the public, that we call it as date of issue of financial statements. Very important. This they might ask you as a question: date of issue of financial statements. Why? Because there was a test your knowledge question regarding this particular term. Understood? Everybody till here comfortable with all the different dates? So now let us go into the further part of the standard. Now we will try to understand what are different auditors' objectives, what are responsibilities of the auditor, what audit procedures he has to perform regarding subsequent events. All that we'll try to understand. So we understood the meaning. Now, what is the objective of the standard? As we have seen, every standard will be given with certain objective. Even SA 560 is also giving certain objectives to the auditor. So as an auditor, you need to obtain sufficient and appropriate evidence whether there are any subsequent events that require adjustments have been properly reflected in the financial statements. So as an auditor, you need to obtain sufficient and appropriate audit evidence whatever subsequent events are there which require adjustment in the financial statements, whether they are really reflected in the financial statements or not. Nothing but this particular part, they're specifically talking about adjusting events. If you find any adjusting events, whether they are really reflected, whether they are given effect to in the financial statements or not, that we need to obtain audit evidence. Similarly, in case if you came to know about any facts that became known to the auditor after the date of auditor's report, like I have told, subsequent events. In case if you came to know about subsequent events after the date of auditor's report, then what you are supposed to do? So if you remember whatever I have told here, see, you have already given your audit report. After you have given the audit report, then you came to know about subsequent event. Now what you should do? You have to respond appropriately. Sir, how to respond appropriately? You need not break your head that how to respond appropriately also. They are trying to say it in the same standard here. Let us try to see what they are actually trying to say, how they have to respond. How as an auditor, you are supposed to respond in case if you came to know about subsequent event after the date of auditor's report. So let us see. Let us go into the standard now. So these are the two objectives. Everybody clear with the objectives? So you have to obtain audit evidence whether the events which require adjustment has been properly reflected in the financial statements. Number two, in case if you came to know about any fact after the date of auditor's report, you have to respond to that appropriately. As simple as that. Sir, first of all, I have to find out the subsequent event. No. before I see whether it has been adjusted in the financial statements, what I have to do in case if I find subsequent event. Before we talk about this, first we need to find out whether there is a subsequent event or not. See, if you have to find out whether there is a subsequent event or not, how you can find it out? Only by performing certain audit procedures. So what audit procedure the auditor needs to perform in order to identify subsequent events? Simply they say five points. What are they? So as an auditor, first you try to understand what procedures management is following to identify subsequent events. So if you pay close attention, before you as an auditor, management is having a primary responsibility to find out the subsequent events, because the management is responsible for preparation of financial statements, and the management, while preparing financial statements, they have to comply with the accounting standards. So before auditor, management will have responsibility to identify the subsequent events. As an auditor, you understand what process your client's management is following to identify the subsequent events. So first you understand it. Then you go and inquire with the management and those charged with governance. Directly go and inquire with the management and those charged with governance. Did they find out any subsequent events? Number 3, read the minutes of the meetings of board of directors and shareholders, especially which are conducted after the date of financial statements. After the date of financial statements, whatever meetings of the board of directors have happened, whatever meetings of the shareholders have taken place, go through the minutes of the meeting. From that also you can identify the subsequent event. And if there are any interim financial statements, if there are any quarterly financial statements, before you complete your audit, even read that interim financial statements as well. And one more thing, you have to even obtain written representation. So simply perform these 5 steps and try to identify subsequent events. So what are the 5 steps? Number 1, try to understand what are the management procedures to identify subsequent events. Number 2, go and directly conduct an inquiry with the management and those charged with governance. Number 3, read the minutes of the board of directors meetings and shareholders meetings. Number 4, read the interim financial statements. Number 5, try to obtain written representations from the management. So if you do these 5 steps, you will first of all come to know whether there is a subsequent event or not. Then once you have came to know about subsequent event, now what responsibilities you have to fulfill, that we are going to see it in the subsequent paragraphs. And if you see here, the auditor's responsibilities are divided into 2 categories. So number 1, facts which became known to the auditor before the date the financial statements are issued. Whereas case 2 is facts came to the auditor's knowledge after the date the financial statements are issued. So very important, guys. See, I suggest you to read the standard from the material ones. Why? Because I have summarized the auditor's responsibility here. But you can't write this chart like this in the exam. You have to write the content. If you have to write the content, you have to read the material ones. So here I'm explaining the concept. It is your responsibility to go through the paragraphs and lines which are given in the material. Why? Because in the exam, you have to write the content, not the charts. So here I will summarize, but the content you have to read it from material. So what are these 2 cases? This also I will try to explain with the help of example. Guys, as I have told, if you take financial year 23-24, I will use some examples. So assume that, why to assume the date of balance sheet, the date of financial statements is 31st of March. Assume that the financial statements are approved by the management on 30th of April 2024. This is the date of approval of the financial statements. Assume that auditor gave the audit report on 31st of May 2024. This is the date of auditor's report. And finally, once the audit report is given, these financial statements will be issued to the third parties, audited financial statements. So assume that that date is 30th of June 2024. This is the date of issue of the financial statements. Now, they are dividing the auditor's responsibilities into 2 categories. Number 1, you came to know about the subsequent events after this date. Then only we call it as subsequent events. So, case 1, you came to know about subsequent events after the date of auditor's report, but before the financial statements are issued. This is case 1. That means by the time you came to know about subsequent event, you have already given your audit report, but you are a little bit lucky here. The financial statements have not yet gone to the third parties. Case 2, you came to know about subsequent event after the date of auditor's report, even after the date of issue of the financial statements also. This is a complicated case. Why? Because in this case, by the time you came to know about subsequent event, audited financial statements have even reached the third parties also. Able to understand? So case 1, the auditor came to know about subsequent events after the date of auditor's report, but before the financial statements are issued. Now what you have to do? Case 2, by the time you came to know about subsequent event, financial statements have already been issued. That is case 2. So what are your responsibilities in case 1? What are your responsibilities in case 2? Both we have to discuss. The same thing we have tried to summarize it here in the form of chart. Let us see what they are telling. First, we will talk about case 1. Facts which became known to facts which came to auditor's knowledge before the financial statements are issued. That means by the time you came to know about subsequent event, financial statements are not yet issued. They have not yet reached the third parties. Although you have given your audit report, the financial statements have not yet gone to third parties. Now, in this case, what you should do? So first thing, the moment you came to know about subsequent event, the first step what you have to do is discuss the matter with the management. You have to go to the management, discuss with them, sir, so and so subsequent event I have identified. As a part of that discussion, determine whether financial statements need amendment. When you discuss with the management, as a part of that discussion, you try to analyze, because of this subsequent event, do the financial statements require amendment? Inquire it. If you have decided yes, financial statements need amendment, then you have to inquire whether management amends the financial statements. Three simple steps, guys. The moment you came to know about subsequent event, before the financial statements are issued, first go and discuss that event with the management. Number two, as a part of that discussion, determine whether financial statements need amendment. See, if the financial statement doesn't need amendment, well and good, no issue at all. When the problem will arise, financial statements need amendment. If you have decided that financial statements need amendment, you have to go and inquire the management. Are they ready to amend the financial statements, or they are not ready to amend the financial statements? So in some cases, what the management will do is, in most of the cases, management will try to amend the financial statements. In some cases, management does not amend the financial statements. So as an auditor, you are feeling financial statements require amendment. But in one case, case one, management might amend. Management will agree, okay, sir, we will amend the financial statements. Then what you should do? Sometimes management will say, no, sir, we will not amend the financial statements. Financial statements require amendment, but the management is telling we will not amend. Then what you should do? Clear? So let us see. We'll talk about what if the management amends the financial statements. Why? Because it is a favorable scenario. So we have decided financial statements need amendment. I asked the management to amend the financial statements. They did not mess with me. They told, okay, sir, we will amend our financial statements. So if the management amends the financial statements, then what you should do? You should perform audit procedures relating to that amendment. So if they have told, okay, sir, we have amended the financial statements, will you blindly believe whatever financial statements they have given? No. So what you should do, whether they have done the amendment properly or not, you have to perform the audit procedures, and you have to obtain sufficient and appropriate audit evidence whether they have done the amendment properly or not. And since they have amended the financial statements, do I require to modify my opinion? No. In this case, you are not required to modify your opinion. You can continue with the old audit report, but one small change you have to do. What you have to do is you have to change the date of the auditor's report. You have to add a new date. What you should do? You have to add a date. You have to change your date. Why? Because see, why I'm specifically asking you to change the date here is, as we have seen earlier, between the date of approval of financial statements and the date of auditor's report, which date should be earlier? Date of approval of the financial statement should be earlier. See, in this case, what has happened is, assume that I have given the audit report on 31st of May already. Then subsequent event was identified. Now management amended the financial statements on 15th June. Now when they have amended the financial statements, it will be approved once again. Assume that these amended financial statements are approved on 15th of June. So my old report, I have given it on 31st of May. But now the newly approved financial statements are containing a date of 15th of June. So can I give the audit report as it is? No. What you should do? You have to give a new audit report, simply changing the date. So change your audit report date also on 15th of June and give that auditor's report. Clear, everybody? Able to understand the same thing they try to say there? Very simple way. So if the management amends the financial statements, you try to perform audit procedures relating to that amendment, try to obtain sufficient and appropriate audit evidence whether they have done the amendment properly or not, and then finally give your audit report, simply changing the date. Why? Because your date can't be older. Change the date and give the audit report. Clear? So this is the favorable scenario. When the actually problem will arise, management is not ready to amend the financial statements. So I am when I discuss the matter with the management, I have decided, we both have mutually agreed that financial statements need amendment, but management is telling, no sir, we don't want to amend the financial statements. This is a problematic scenario. No, in this also two cases could be there. Audit report is not yet given to the management. Sir, what is this audit report not yet given to the management? Take for example, you have signed the audit report on 31st of May. You thought you will give the audit report on tomorrow morning. I will come and give the audit report. But before you could hand over that audit report to the management, you came to know about subsequent event. You discussed with the management, you decided financial statements need amendment, but the management is telling we will not amend the financial statements. But here you are in a favorable scenario. Why? Because even though you have signed the audit report, you have not yet delivered it to the management. The audit report is still with you. So you have decided financial statements need amendment. You asked the management to amend. They told, no, we will not amend. But here you are in a favorable scenario. The audit report is still there with you only. You did not give it. Then what you should do? Very simple. Tear that audit report which is there in your hands, throw it in the dustbin, give a new audit report containing a modified opinion. What you should do, throw the old audit report. Since you have not yet handed it over to the management, you throw away that audit report, give the new audit report containing a modified opinion. Clear? But when will be a problematic scenario? You came to know about subsequent event, you have decided financial statements need amendment, management is telling we will not amend the financial statements, you have signed the audit report and you have given it to the management also. Here, you don't have audit report in your possession. You have already given that audit report to management. Now what you should do? Now what you should do is first to go and instruct the management not to circulate the audit report. Go to the management and say, sir, whatever audit report I have given to you, don't circulate it. But sometimes management, what they will do is, even after auditor goes and requests the management not to issue that audit report, they will still issue it. Then what auditor should do? Then the standard says, if the management has circulated, even after you requesting not to circulate, if the still management has circulated, as an auditor, you have to take appropriate action to stop the people from relying on the auditor's report. So as an auditor, it is your responsibility to take appropriate action to stop the people from relying on auditor's report, like giving a newspaper advertisement, giving a news announcement. So whatever it is, take appropriate action to stop the people from relying on the auditor's report. And now finally, what you can do is give a new audit report containing the modified opinion, give it to the management, ask them to circulate it. Clear? Able to understand? So this is what auditors should do in case if the facts came to auditor's knowledge before the financial statements are issued. Comfortable? Now, sir, what if auditor came to know about subsequent events, but by the time he came to know about the subsequent event, financial statements have already issued, financial statements have already gone to the third parties. In that case, what auditor should do? Here also same steps. First, discuss the matter with the management. As a part of the discussion, determine whether financial statements need amendment. Then you have to inquire whether management agrees to amend the financial statements or not. The same 3 steps we have to do. But here, one more additional step you have to do. If you have decided financial statements need amendment, see, by the time you came to know about subsequent event, the financial statements and audit report is already there with third parties, no? Is already there with the common public, no? So first thing what you should do is, you should ask the management to take appropriate action to stop the people on relying the auditor's report. Why? Because by the time you came to know about subsequent event, financial statements have already reached the third party. So go and request the management, sir, financial statements need amendment, but we have already given it to the third parties. So you please take some appropriate action to stop the people from believing on our auditor's report. So go and ask the management to take appropriate action. Sir, what if management is not taking appropriate action? We went to the management and told, sir, we have to amend the financial statements, but the third parties have already received it. Ask them not to rely. But management is telling, no, we will not take any appropriate action. The standard says if the management does not take any appropriate action, as an auditor, you have to take the appropriate action to stop the people from relying on auditor's report. If the management takes the action, well and good. If the management refuses to take any action, as an auditor, you yourself have to take an appropriate action. So whatever it is, either management or the auditor, first someone has to take an action to stop the people from relying on auditor's report. Then what we'll do? Then the same thing. We have to see whether management agrees to amend the financial statements or management does not agree to amend the financial statements. If the management agreed to amend the financial statements, well and good, we'll perform the audit procedures relating to that amendment and we'll try to obtain sufficient and appropriate audit evidence whether they have done the amendment properly or not. And we will give a new audit report which doesn't contain any modification. We'll give unmodified opinion only. Why? Because management did the amendment. But the standard says in the new audit report, whatever you are giving, either you use emphasis of matter paragraph or other matter paragraph. And in that emphasis or other matter paragraph, what I have to say? What you have to say is, see, you have already given an audit report and financial statements. They have gone to shareholder. Now you are giving new financial statements and new audit report. Now the user might get confused. What is the difference between old financial statements and new financial statements? So as an auditor, you in your emphasis or other matter paragraph, highlight what is the difference between old financial statements and the new financial statements, either in the emphasis of matter paragraph or other matter paragraph. Clear? So this is what as an auditor you are supposed to do if the management agrees to amend the financial statements. When the problem will arise, when the management doesn't agree to amend the financial statements. I am telling management to amend, but they are telling, no, we will not amend the financial statements. Now what we will do? As an auditor, we will give a new audit report which contains a modified opinion, either a qualified or adverse. We will give a modified opinion depending on materiality and pervasiveness. And we will explain what are the reasons for giving this modification in the basis for modified opinion paragraph. Here we don't need any emphasis or other matter paragraph. Why? Because anyhow, we are explaining the reasons in the basis for modified opinion paragraph. Clear, everybody? So this is what the auditor's responsibilities will be in case if he comes to know about subsequent event after the financial statements are issued. Clear? This is what overall SA 560 is about. I request you, in this chart I have only summarized the concept. I request each and everyone to go through the content, but in line with this explanation, if you read the content from the material, you will be able to easily understand it. Comfortable, everybody? So this is what regarding SA 560. Everybody able to understand till here? So now we will take up, since we are done with SA 560, the next standard which we will take up for revision will be SA 570. We will try to understand, very important standard, very important from the examination perspective. So without any delay further, let us try to understand what does this SA 570 talk about. So as you could see, the title of the standard SA 570 is going to talk about the auditor's responsibility relating to going concern assumption. So it is talking about, see, this point I have already clarified. Standards on audit actually talks about auditors' responsibilities. It doesn't talk about accounting treatment. It doesn't talk about management responsibility. So when I say SA 570 is talking about going concern, this standard is actually trying to specify what are the auditor's responsibilities in relation to going concern assumption in the process of conducting the audit of the financial statements. See, before we talk about auditors' responsibilities regarding going concern, let us first try to focus on what is the importance of the going concern assumption in the financial statements. Do you think going concern plays any important role in the preparation of the financial statements? 100% yes. Why? Because if you remember, if you go back to the basics of the accounting, there are three fundamental accounting assumptions over which the financial statements will be prepared. What are the three basic fundamental accounting assumptions? Going concern, accrual, consistency. So going concern is one of the fundamental accounting assumption in the process of preparation and presentation of the financial statements. Sir, what kind of impact the going concern will have on the financial statements? What kind of impact, or how the going concern assumption will affect the financial statements? See, if you take the balance sheet of any entity, if you see, there will be fixed assets. See, in the fixed assets, assume that the fixed assets are shown at a value of 100 crore rupees. And you take another item of the balance sheet, there is inventory. Inventory has been shown at a value of 50 crore rupees. Now I'm going to ask you a few questions. You please try to respond. See, when I show the fixed assets at 100 crore rupees, can you give me a guarantee if I sell all the fixed assets as on the balance sheet date, will I be able to fetch the value which has been stated in the balance sheet? No. So when it comes to fixed assets, we can never ever give the guarantee that the fixed assets will fetch the value as given in the balance sheet. We can't give that guarantee. Why? Because fixed assets are valued using historical cost approach. Fixed assets are valued using historical cost approach. Whereas if I ask the same question for inventory, will you be able to realize the amount stated in the balance sheet if you sell the inventory as on the balance sheet date? The answer will be yes. Why? Because here we follow realizable value. So for inventory, we are following realizable value. For fixed assets, we follow historical cost. Why, sir? For two different assets of the same entity, different valuation approaches. The logic is very simple. We hold fixed assets with the intention of selling it in the ordinary course of business. We hold the inventory with the intention of selling it in the ordinary course of business. So that's why we value the inventory at realizable value. But we hold fixed assets not to sell it in the ordinary course of business. We hold the fixed assets for the purpose of using it for further continuation of the business. That's why we follow historical cost approach. Which means when I'm telling we are holding the fixed assets not with the intention of selling it in the ordinary course of business, that means we have a reasonable estimate to continue in the future. That means the point which I'm driving here is very, very important. We can value our fixed assets or any other assets using historical cost approach only till the point of time going concern assumption is appropriate. That means when the management is reliable that entity will continue for the coming 1 year, when there is that certainty, then only entities will follow historical cost approach for fixed assets. However, if the going concern assumption becomes inappropriate, so what do you mean by going concern assumption becoming inappropriate? That means entity will not continue for the coming 1 year. So if the going concern assumption is inappropriate, in that circumstances, we hold even fixed assets for the intention of selling it in the ordinary course of business. In that case, we can't value even the fixed assets on historical cost basis. We have to value fixed assets even on realizable value basis or liquidation basis also, they say. What do they say? Liquidation basis. That means when we hold any asset, any liability with the intention of disposing it in the ordinary course of business, we have to determine as on the balance sheet date how much value they will fetch, and that realizable value or liquidation value, we will value all our fixed assets. When the going concern becomes inappropriate, not just fixed assets, guys, if the going concern assumption becomes inappropriate, all the assets, all the liabilities, everything will be determined, everything will be valued as if we are holding it in the ordinary course of business.
So we can continue to follow historical cost of approach for fixed assets only till the point of time going concern assumption is inappropriate. The moment going concern assumption becomes inappropriate, all the assets, all the liabilities, we will determine its realizable value. All the assets and liabilities, we will evaluate it realizable value, and the differential, if any, we will take it to the statement of the P&L. So that much impact going concern assumption is going to have on the preparation of the financial statements. So if you see here, we have given the importance of the going concern assumption. So what is the importance of the going concern assumption? Meaning of going concern and its significance, very, very important from the examination perspective, guys. Please go through this paragraph once. So nothing but whatever I have explained you till now, the importance of the going concern assumption in the preparation of financial statements. The same thing in case if they ask you in the examination, you have to write it, right? So in order to get that clarity in writing, so please refer to this paragraph, whatever has been given in the material, meaning of the going concern assumption and also its significance. Nothing but whatever I have explained you till now, the same thing has been given in the paragraphical format here. Okay, so we have understood what is the importance of the going concern assumption in the preparation of the financial statements. Now let us talk about auditor's responsibilities. See, till now whatever I have explained, that is not from the standard on audit, that is from the accounting standards perspective. So now we will try to understand, okay, since we understood the importance of the going concern assumption in the preparation of the financial statements, now let us talk about what will be the auditor's responsibilities in case if you are conducting audit of the client X Limited. This client X Limited has prepared the financial statements. Now as an auditor, while conducting the audit of these financial statements, what are your responsibilities relating to going concern assumption? Clear? So let us try to understand the concept of the standard now. Now we are going into the standards on audit. Till now, whatever we have discussed, that is actually from the accounting concepts. So first of all, let me ask you a few questions. Who is primarily responsible for making assessment regarding going concern? Who is having the primary responsibility to make an assessment regarding going concern? Management or the auditor? The answer is always management. Management is responsible for preparation of financial statements. The management is responsible for making assessment regarding entity's ability to continue as a going concern. Whether entity will continue for the next 1 year or not, that responsibility has to be there always on the management. The management is responsible for making that assessment regarding going concern. Then what auditor will do? Auditor will try to obtain sufficient and appropriate audit evidence whether the assessment made by the management regarding going concern is valid or not. That means, for example, management will study the organization and they will decide whether going concern assumption is valid or not. If the management is telling going concern assumption is valid, as an auditor, I will try to obtain audit evidence whether really the going concern is valid or not. If the management, after making their assessment, they are telling that no, going concern assumption is invalid, I will try to obtain audit evidence, whatever management is telling, whether it is correct or not. Obtaining audit evidence is my responsibility, whereas the primary responsibility for making assessment regarding entity's ability to continue as a going concern will always rest on management. So first thing we have to be clear about it. So responsibility for making assessment regarding going concern. Who is responsible for making assessment regarding going concern? As you could see here, the primary responsibility is with the management. So management is primarily responsible for making an assessment regarding going concern. Okay, sir, management will make an assessment regarding going concern, but how they will decide? On what factors they will consider, what different factors they will consider to determine whether entity will continue for the next 1 year or not? How they will say? They will consider various factors. No, they will not simply take a coin toss and say heads, if heads comes going concern is valid, if tails comes going concern is invalid. It will not happen in that way. If the management is making an assessment regarding going concern, they will consider a numerous factors. So what factors will be considered for making assessment regarding going concern? Number one, size and complexity of the entity. So you have to pay attention to what is the size of the organization, what complex operations they are doing. Nature and condition of business. The management also should consider what is the nature of their business, what is their current condition of the business. Are they generating money? Are they not generating money? Are they able to pay their liabilities? Are they not able to pay their liabilities? So they will even consider nature and condition of the business, and even uncertainty of events and conditions. Like for example, if the client is going through some case, in case if the company loses that case, the penalty will be so huge that they will go bankrupt. So like that, if there are any uncertain events and conditions, the management will even consider the effect of that uncertain events and conditions also. And even they will consider effect of external factors like changes in the laws and regulations, etc., etc. So all these factors the management is going to consider. Then they will make an assessment regarding going concern, whether entity will continue for the coming 1 year or will not continue for the coming 1 year. That analysis the management will do after considering all these factors. Okay, sir, we have seen what is management's responsibility, but now what is auditor's responsibility? to obtain, see here, to obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of going concern assumption. That means on considering these factors, whatever assessment management has made regarding going concern, whether that assessment of the management is valid or not, that auditor is trying to obtain sufficient and appropriate audit evidence. And also on the basis of that evidence, you need to even determine whether there is any material uncertainty relating to going concern. So in the process of that performing audit procedures, you have to determine whether there is any material uncertainty relating to going concern, and you have to report it in accordance with SS. These three are objectives. So don't worry about this. What is this material uncertainty? Next point will come to that only. But for now, they might ask you a question, what are auditors' responsibilities relating to going concern? Or they even might ask you a question, what are the objectives of the auditor as per say 570? These 3 points you are required to write. I will explain whatever points they have told, that I will explain, but 3 points you have to remember. Number 1, the auditor is responsible for obtaining sufficient and appropriate audit evidence regarding appropriateness of management's use of going concern assumption. Number 2, whether material uncertainty relating to going concern exists. Number 3, you have to report in accordance with the essay. So how to report? That's what we will try to discuss now. Okay, so first we will come to the reporting part. I'm going to explain it in a simple way, how the going concern will have a impact on the auditor's opinion. See, once the auditor has performed audit procedures, in the objective they are telling, as an auditor, we are required to obtain sufficient and appropriate audit evidence. Sir, how we can obtain sufficient and appropriate audit evidence? By performing audit procedures. What audit procedures we will perform? That we will talk about it later. What audit procedure auditor has to perform, that I will talk about it later. We will come to that later. So whatever it is, auditor will perform audit procedures. After performing audit procedures, auditor will have certain observations regarding going concern. So there could be 3 kinds of observations. After the auditor has performed audit procedures, there could be 3 kinds of observations. Auditor has concluded that going concern assumption is appropriate. Going concern assumption is appropriate. Or auditor might find that going concern assumption is inappropriate. Going concern assumption is inappropriate. Or auditor also might think that going concern assumption, or sorry, the third scenario which could be possible is material uncertainty relating to going concern. There is a material uncertainty relating to going concern. Clear, everybody? So once auditor has performed all the audit procedures, which we are about to see it in the standard, there could be 3 kinds of observations. Number 1, he might conclude that going concern assumption is appropriate. Yes, entity will continue for the coming 1 year. Or in some cases, he might find that going concern assumption is inappropriate. That is, entity will not continue for the coming 1 year. There is a sure evidence is that entity will get closed down in the coming 1 year. There is another scenario, material uncertainty relating to going concern. This I will come to later. First, we will discuss the first 2 cases. As an auditor, you performed audit procedures and you came to know that going concern assumption is appropriate. Management has prepared the financial statements on going concern basis only. Now, will there be any requirement to modify your opinion? The answer is very simple. Here, nothing you are supposed to do. Simply give an unmodified opinion. Why? Because going concern assumption is valid only. Entity will continue for the coming 1 year. There is no issue at all. So, going concern assumption is valid. So, no impact on the opinion. Unmodified opinion only we will give. Now, let us come to the second case. As an auditor, you came to know that entity will not continue for the coming 1 year. Entity will definitely not continue for the coming 1 year. Now, what you will do? So, directly will you go modified? No. The standard says here you need to check. In case if the going concern assumption is inappropriate, you need to check 2 things. You need to check one particular thing. Whether proper disclosure, or adequate disclosure also you can say, whether adequate disclosure is given in financial statements. By whom? Management. Or no adequate disclosure, no adequate or proper, whatever you want you can use, no adequate disclosure given in financial statements. So once you have decided going concern assumption is inappropriate, now the next thing what you need to check is whether the management has given a proper disclosure or management did not give a proper disclosure in the financial statements. Sir, what do you mean by giving a proper disclosure in the financial statements? What do you mean by giving a proper disclosure? Giving a proper disclosure means management has also agreed that yes, going concern assumption will be invalid. They have valued all their assets and liabilities on realizable value basis. The differential has been taken to the statement of P&L. In the notes to accounts also, they have clearly told that we will not continue for the coming 1 year. That is what the meaning of giving proper disclosure. So what is the meaning of management giving proper disclosure? They have valued all the assets, all the liabilities at their realizable value, and have taken the differential component to the statement of P&L, and also they have given a proper explanation, the notes to accounts, that they will not continue for the coming 1 year. In this case, you tell me, did they do any mistake? Have they done any mistake? No, in this case they have not done any mistake. So in that case, what auditor will do? Unmodified opinion only he will give. The auditor will do unmodified opinion only he will give. Why? Because the management gave a proper disclosure. But here the standard says, since the management has given proper disclosure, but you want to highlight it somewhere in your auditor's report. Management has given a proper disclosure, but you want to highlight it in the auditor's report. Then what you can do is you can use an emphasis of matter paragraph in the auditor's report to highlight. Nothing but we will tell the reader of the auditor's report, boss, I'm giving unmodified opinion, but the going concern assumption is invalid. Regarding this, the management has already given a disclosure in the financial statements at so and so note number. Please go and refer. So you can highlight that information in the emphasis of matter paragraph. So when the going concern assumption is inappropriate, and when proper disclosure is given in the financial statements, auditor will give unmodified opinion only, but that information he can highlight it in the emphasis of matter. Sir, what if no adequate disclosure has been given? That means going concern assumption is inappropriate, but management is still continuing to value all their fixed assets at historical cost. They did not give a proper explanation that entity will not continue for the coming 1 year. So going concern assumption is inappropriate, but no adequate disclosure has been given in the financial statements. In those cases, what I have to do? The standard says give a modified opinion, and the standard has asked you to go to an extreme level. So you have to go and give directly adverse opinion. What opinion you should give? You have to directly go and give adverse opinion. Why? Because the effect of going concern is material and pervasive. It will not be just material, it is going to be material and pervasive. So in case if the going concern assumption is inappropriate, and if there is no adequate disclosure given, directly give the adverse opinion, and reasons you explain in the basis for adverse opinion paragraph. In the basis for adverse opinion paragraph, you have to give your reasons. Clear? Comfortable, everybody? So this will be the responsibilities of the auditor in case if the going concern assumption is inappropriate. Let us come to the third part, material uncertainty relating to going concern. This I will write it here. Material uncertainty relating to going concern. Sir, what is this typical scenario? See, in this scenario, we have understood the first two. Going concern is appropriate means entity will continue for the coming 1 year. Going concern is inappropriate means entity will not continue for the coming 1 year. Material uncertainty relating to going concern means? Material uncertainty means whether entity will continue for the coming 1 year or will not continue for the coming 1 year. It depends on some circumstances. There is some uncertainty. We don't know whether entity will continue in the future or will not continue in the future. That depends on some circumstances whose outcome is uncertain. We don't know what will happen. I will tell you one typical scenario, one simple case I will tell you. For example, assume that the client X Limited is there. So this client is going through some case in the Supreme Court. Now the case is still pending for discussion. There are two options. In case if the company loses the case, the amount will be so big that entity will be sealed, entity will be closed. Or in case if the company wins the case, there will not be any problem to the going concern assumption, entity can happily continue. So whether this entity will continue for the coming 1 year or not, that is depending on outcome of this case. But what is the outcome of that case? That is uncertain. Whether the company will win the case or lose the case, that is uncertain. So this typical scenario, we call it as material uncertainty relating to going concern. Whether entity will be able to continue for the coming 1 year or will not continue for the coming 1 year. It is depending on some circumstances which is uncertain. Clear? Now in this case, what I have to do? If there is a material uncertainty relating to going concern. So in this case also, the standard says there could be two cases. So there is a material uncertainty relating to going concern. In that case, you have to check whether adequate disclosure given in financial statements by the management, or no adequate disclosure given in financial statements. Sir, what do you mean by adequate disclosure given in the financial statements? The management is going through this uncertainty. Okay, but the management did not hide it. In the financial statements, they have given one note. In that note, they have clearly explained, sir, so and so case is going on. In case if we win the case, we can happily continue. In case if we don't win the case, we might have to pay a huge amount of penalty. And we have appointed a lawyer, we have appointed a reputed lawyer who is fighting the case for us. So like that, without any mistake, they have clearly explained who management without hiding anything. They have clearly explained that information in the notes to accounts. That is what the meaning of adequate disclosure given. So when there is a material uncertainty and the management has given an adequate disclosure, has the management did something wrong? No. Whatever uncertainty they are facing, they have clearly explained in notes to accounts. Are the financial statements giving true and fair view? Yes. Why? Because management did not hide anything. So what opinion will be given in this case also? I will give unmodified opinion only. But don't you think this matter should be brought to the notice of the shareholders? Management gave the disclosure, but as I have told, since every user might not read the financial statements fully, don't you think there is a responsibility on you to bring this information to the notice of the shareholders? Yes. How you can highlight it to the shareholder? You will say emphasis. You are correct, but actually wrong. So you could highlight it in the emphasis of matter paragraph, but SA 570 specifically says that these material uncertainty, if you want to highlight it, don't highlight it in the emphasis of matter paragraph. Use a separate paragraph, material uncertainty relating to going concern. Use a separate paragraph, material uncertainty relating to going concern. In that paragraph, you highlight that uncertainty. In that paragraph, you highlight that uncertainty. See, if the standard did not have told this, we would have definitely highlighted in the emphasis of matter only. Like as you could see here in the previous case, when the going concern is inappropriate, we will give unmodified, but we'll try to highlight it in the emphasis. Why? Because standard did not say specifically anything. But when it comes to material uncertainty, the standard has specifically told that you give unmodified opinion, but highlight that information in a separate paragraph which contains the heading material uncertainty relating to going concern. In that paragraph only you have to highlight. If they did not have told this, we would have highlighted in the emphasis, but the standard is specifically asking us to use a separate paragraph with this heading, so we have to use it and highlight that information in this paragraph. Clear? So when material uncertainty relating to going concern is there, when adequate disclosure is given, you will give unmodified opinion, but that information you will highlight it to the shareholder by using a separate paragraph called material uncertainty relating to going concern. Next case, sir, what if there is no adequate disclosure? That means the management is going through some uncertainty, but the management did not give a disclosure, did not give that explanation in the financial statements. So in that case, what the standard says is you have to give a modified opinion. Sir, which kind of modified opinion I have to give? Either you have to give qualified or adverse, depending on materiality and pervasiveness of that uncertainty. You have to give either qualified opinion or adverse opinion, and the reason for that qualified or adverse opinion paragraph, you have to explain that in the basis for opinion paragraph. Sir, here also is there any requirement to use material uncertainty relating to going concern? No. Material uncertainty relating to going concern, that paragraph is not required here. Why? Because you are giving a modified opinion, and the reasons you are explaining it in the basis for modified opinion paragraph. There is no requirement of material uncertainty relating to going concern paragraph here in this case, but in this case we require material uncertainty relating to going concern. Clear? So I have explained you the reporting requirements. So if we go through the content of that standard, so if we talk about auditors reporting, see, when going concern is appropriate, we need not discuss specifically anything. So what if the going concern is inappropriate? What will be our reporting requirements? This I have clearly explained. Sir, what if there is a material uncertainty relating to going concern? Here also two cases, disclosure is there, no disclosure is there. When disclosure is there, what you should do. When disclosure is not there, what you should do. That is also clearly explained. But there will be one more case. In some cases, what the management will do is, management is unwilling to share its assessment, which means management had made an assessment regarding going concern, but they are not sharing it with you. On what basis they have done the assessment regarding going concern? What is their conclusion regarding going concern? That management is not making available the assessment, whatever they have done. In that case, what I should do? See, as an auditor, I need to obtain sufficient and appropriate audit evidence. For that, regarding going concern, for that management should give me the details. But management is not sharing their assessment with you. Then what you should do? Then you will not be able to obtain audit evidence. When you are not able to obtain audit evidence, what you should do? Either you have to give a qualified opinion or disclaimer of opinion. Why? Because this is a case of non-availability of audit evidence. Understood, everybody? So if the management is unwilling to make its assessment available to the auditor, in that case, that means management is not sharing the information. You don't have audit evidence in that case. In that case, you will give either a qualified opinion or you will give a disclaimer of opinion. Understood, everybody? So these will be the reporting requirements of the auditor regarding the going concern assumption. Clear? So we are done with audit reporting, but as I have told, first we need to perform audit procedures. No, see, we will get these conclusions only when we have performed audit procedures. We have seen after audit procedures what will be our observations, what will be our reporting requirements, but how we will get that audit evidence? By performing audit procedures. So what audit procedures auditor has to perform regarding going concern assumption? Let us have a quick look at it. So audit procedures regarding going concern assumption are divided into two categories. Number one is risk assessment procedures and number two is further audit procedures. So what auditor should do regarding risk assessment procedures? Number one, the auditor shall consider whether any events or conditions exist that may cast a significant doubt on entity's ability to continue as a going concern. So first, what the standard is asking you to do is you try to identify, are there any events or conditions which will give you a hint that there could be a possibility of going concern going invalid. That means they are not asking you to directly find out whether going concern is valid or not. First, they are asking you to identify, are there any indicators which will create a doubt to the auditor regarding going concern assumption? So that you have to do. How I can identify? First of all, what are that events or conditions which create a doubt regarding entity's ability to continue as a going concern? Those are actually given in the standard only, and those indicators are actually divided into three categories: financial indicators, operating indicators, and other indicators. Sir, what could be financial indicators? Like company is always having a net liability position. They're having long-term borrowings which are approaching maturity, but the company is not having funds to make the payment. Negative cash flows they are continuously incurring. Withdrawal of financial support. The creditors are withdrawing their financial support. Adverse financial ratios are having a bad financial ratios. Or there could be operating indicators like managements themselves are having an intention to liquidate the company, or loss of key management. The key management in the organization, they have lost it. Labor difficulties, they are not able to find the labor for their work. Shortage of supplies, whatever raw material they are using which is required for their business, that is under short supply. Successful competitor, or all of a sudden a successful competitor has come who is eating away all your business. And there could be other indicators like non-compliances with the laws and regulations, pending cases. There are some calamities or catastrophes which are uninsured, and there could be changes in the laws and regulations. So first thing, as an auditor, what you should do is you should try to identify whether any of these events or conditions exist which will create a doubt regarding going concern. Sir, how I will come to know about any of these events and conditions are existing or not? By simply inquiring the management. What you should do? By simply inquiring the management if such events and by simply inquiring the management whether any of these indicators are there. Yes, you found some indicator. By inquiring the management, you found some indicator. If you find that events are indicators, then you have to perform the further audit procedures. On the other hand, if you inquire the management, you are unable to find out any of this operating, financial or other indicators, then you need not proceed any further. There your responsibility will come to an end. Like the way we have seen in SA 501. So same logic here. If by inquiring the management, if you find out any of the operating, financial or other indicator, then we will perform further audit procedures. If we don't find any indicator, then we will stop with the risk assessment procedure. With inquiry only, we will stop. When we actually get to know any of this indicator, when we found any one of this indicator, then what we will do? Then we will perform further audit procedures. Sir, what further audit procedures I will perform? Very simple. Request the management to make the assessment. If not yet done, if the management has not already made the assessment regarding going concern, I will ask the management to make the assessment now. Evaluate management's plans for future. Try to sit with the management, understand what are their plans for the future. Analyze the cash flow forecast. They will prepare cash flow estimate for the coming 1 year. Analyze that cash flow forecast. Or even you can ask for written representation. You can analyze the profits, cash flows of the company, read the latest interim financial statements, inquire legal counsel, go and consult the legal department, inspect the loan agreements, and also read the minutes of the meetings of board of directors. So perform all these further audit procedures. Then you will get the observations like we have told. Going concern is appropriate, inappropriate, or material uncertainty, and depending on your observation, you have to have a impact on your auditor's opinion. Clear? So this is what regarding SA 570, one of the most important standard from the examination perspective. Hope you guys are able to understand this. So we are done with two more standards, SA 560 and SA 570 also we are done with. Clear and comfortable everybody till here? The next standard which we will take up for revision will be SA 550 we will try to discuss. Try to revise SA 550. Very simple standard, very small standard, very easy from the examination perspective as well. So we'll try to revise now SA 550 talking about related parties. See, if you pay close attention, under applicable financial reporting framework, there will be a lot of special care which will be given to the related party transactions. Like if you see Schedule 3, in the Schedule 3, there are separate disclosure requirements when it comes to related party transactions. Similarly, when you have a look at accounting standards, we have dedicated accounting standards which are talking about the related party relationships and transactions. So especially when it comes to related party transactions in the applicable financial reporting framework, a lot of emphasis will be given to the related party transaction. Why? Why there is a special attention required for the related party transaction? The logic is very simple. Whenever there are related party transactions, the chances for manipulations are very, very high. When two parties are related, they can influence each other, they can dominate each other, and they can manipulate the terms and conditions, and it is a little bit easier to commit frauds and crimes when the transactions are related party transactions. So that's why a lot of special care has been given in the applicable financial reporting framework. They ask the companies to give a lot of disclosures, a lot of explanations, lot of explanations are required to be given when it comes to related party transaction. Similarly, from the audit perspective also, related party transactions are highly important. So that's why we have a dedicated standard on audit, which is talking about auditors' responsibilities relating to related party transactions while conducting the audit of the financial statements. Since there is a high chance of happening of fraud or crimes in the related party transactions, even the ICA has given a dedicated standard which is talking about exclusively auditors' responsibilities regarding the related party relationships. So let us try to understand what are that related party responsibilities, what are that auditors responsibilities as per SA 550. So before we talk about responsibilities and all, let us try to understand what is the meaning of the term related party. See, under Companies Act there is an exhaustive definition for related party. Under accounting standards also we have an exhaustive definition for related party. Then how come related party was defined in the standards on audit? See, in the standard on audit, the standard is trying to be on a safer side. The standard simply told that if the applicable financial reporting framework has already defined the term related party, please follow that definition only. What the standard on audit has told, it is trying to play it on a safer side. So what it is telling is, if the applicable financial reporting framework of the client has clearly defined the term related party, follow that definition only. Like if I'm conducting audit of a company, for company applicable financial reporting framework is Schedule 3 and accounting standards. Since in the Schedule 3 and accounting standards, the related party term is already exhaustively defined, we have to follow that related party definition only. Clear? So that's what it says. If applicable financial reporting framework has already defined related party, follow the same definition. In case if the applicable financial reporting framework does not define the term related party, or the definition given to the related party under applicable financial reporting framework is very, very minimal, then they have given some definition to the related party in this standard. And when this definition has to be followed, this definition has to be followed only when the applicable financial reporting framework did not define the term related party in a proper way. If applicable financial reporting framework has defined it, we will follow that definition only. In case if applicable financial reporting framework provides minimal or no definition, then related party includes the following. So what is that? Number one, a person or entity that has control or significant influence over reporting entity directly or indirectly. Take for example, your client is X Limited. Some other entity is controlling or having a significant influence on your client company. Assume that some Y Limited is having a control or significant influence on the client X Limited. Then X and Y will become related. Or another entity over which reporting entity has significant control or influence. That means assume that your client is X Limited, your client is having control over some other entity Z Limited, then also it becomes a related party. Or another entity that is under common control with the reporting entity, that means some other entity and your client entity both are under common control. Some common control is there between the two, either by way of common ownership. For example, one person is holding a ownership in X and Y, or they are under common control because the owners are close family members, or they are having a common key management. Able to understand? Guys, very simple. In case if the applicable financial reporting framework does not define the term related party, then the related party includes someone who is having control over our client, or our client is having control over somebody else, or my client entity and someone else we both are under common control. How that common control is arrived? Either by way of common ownership. In my client entity and some other entity, both are having some common person is holding the shares. Or my client entity, some other entity, both are having common owners. My client entity, some other entity, we are having common key management. Then also we will fall under related parties. Clear? Very simple, guys. So if I put it this way, assume my client company is there. Someone is having control over client company. That will be related party. My client is having control over somebody else. That also will be related party. My client entity is there, some other entity is there, we both are under common control. That common control could be by way of common ownership, or same owners, or owners are close family members, or even that could be common key managerial person like common directors, common CEO, common CFO. So these are the definitions of related party as per the standard, and this definition has to be followed only when the applicable financial reporting framework has a minimal or no definition. If the applicable financial reporting framework has a clear definition for related party, we will follow that only. However, one important point which is very, very important for the true or false statements, entities which are under common control by a state are not considered to be related unless they engage in significant transactions or share resources. So, see, I told when two entities are under common control, then we call it as related party, no? But this point does not become applicable for government, where two entities are controlled by same government, state in the sense government here. When two entities are under common control of the government, then they will not be treated as related parties unless they share the resources or unless they both are engaged in some significant transactions. See, what they're trying to say here once again is, so assume that there is a company X Limited, there is a company Y Limited. Under both of this, the control is exercised by government. See, practically speaking, as per the definition, these both, since they are under common control, they has to be related, they has to be treated as a related party. But when the common control is exercised by the government, they will not be treated as a related party directly unless they both are sharing the resources. This X Limited and Y Limited, they are both sharing the resources. Then we can treat them as a related party, or they are having some significant transactions between them. If they are engaging in some significant transactions, then only we call it as related. Just because two entities are under same control of a government, we will not treat it as a related party. Clear? So this is one important thing from the examination perspective. So this is what the meaning of related party. Now, what is the nature of related party transaction? See, generally, when the related party transactions are in the normal course of business, when the related party transactions are normal course of business, like terms and conditions are same, there is no special privilege given to the related party, whatever terms and conditions which are applicable for a third party, same transactions are also applicable for related parties. So if the related party transactions are carried out in the normal course of business without any special treatment given for related parties, then generally there will not be higher risk of material misstatement. There will be normal transactions only. We need not get worry about it when the related party transactions are in the normal course of business. No special privilege is given. Whatever terms and conditions which are applicable for a third party, the same terms and conditions are also applicable for related party. If that is the case, in that case, there is no higher risk of material misstatement. We need not worry much. But however, in some cases, related party transactions may give rise to high risk of material misstatement. This point is repeatedly listed in the examination. In some cases, the risk of material misstatement arising from related party transactions will be very higher. Sir, in which circumstances the risk arising from the related party transactions will be very high? Number one, related party transactions operate through extensive and complex relationships. So related parties are not direct relationships. They are engaging in very complex relationships. Like for example, I am conducting audit of client X Limited. This X Limited is having one subsidiary. That subsidiary is having another subsidiary. That subsidiary is having an associate company. In that associate company, one of the directors is a partner in firm XYZ and O. Now this entity will become related party to this. But the relationship is very complex. See, when the relationship is very complex, sometimes management themselves may not be able to identify who is a related party. So that's why when the related parties are operating through extensive and complex relationships, then the risk will be very, very high. Or sometimes the information systems which are used may be ineffective at identifying or summarizing the related party transactions. Today, organizations are using softwares. So in big entities, in their accounting software, there will be a specific function which will automatically identify the related party transactions and identify the disclosure. In case if the client's accounting software is not that advanced, if the client is using accounting software which is ineffective in identifying related party relationships or transactions, then also the risk will be very high. Similarly, related party transactions may not be conducted under normal market terms and conditions. That means you are giving special treatment. You are doing the transactions without consideration. Then also the risk will be very high. So they might ask you a question, what are the circumstances in which the related party transactions risk could be higher? So three things you are supposed to write. Example, number one, when the related party transactions are operating through complex relationships and extensive relationships. Number two, information systems which are used by the organization are ineffective in identifying the related party relationships. Number three, related party transactions are not getting conducted under normal market terms and conditions. In these cases, generally the risk is higher. On the other hand, if the related party transaction is happening in the normal course of business only, then the risk will be lower. So we have seen what is the meaning of related party, what is the nature of the related party relationships. Next, we'll talk about responsibilities of auditor. So as an auditor, what you are supposed to do when it comes to your responsibilities of auditor regarding the related party transactions. Number one, as an auditor, we need to obtain audit evidence regarding accounting and disclosure requirements. As I have told, as per applicable financial reporting framework, there are so many accounting and disclosure requirements given under Schedule 3 and accounting standards. So as an auditor, I need to obtain sufficient and appropriate audit evidence. Whatever accounting and disclosure requirements are there, which are given under applicable financial reporting framework, whether they are followed or not, I need to obtain audit evidence. So how I should do it? Let us see. So the auditor should obtain audit evidence regarding accounting and disclosure requirements. How he will get to know it? For that, he shall perform audit procedures to obtain an understanding of accounting and disclosure requirement. First, you should go through the applicable financial reporting framework and understand what are actually the accounting and disclosure requirements of related parties. Then you need to obtain understanding of related party relationships and transactions. First, you understand disclosure requirements. Then you understand who are your clients related parties, who are having the what kind of relationships they are having with the related parties. And finally, you have to conclude whether financial statements give a true and fair view and they are not misleading, particularly because of the related party transactions. Because of related party transactions, the financial statements are not misleading. They give a true and fair view. That also we need to obtain audit evidence. So as an auditor, that is your first and primary responsibility, to obtain audit evidence regarding accounting and disclosure requirements. Number two, you need to even identify fraud risk factors. Sir, what is fraud risk factor? See, fraud risk factors means the chances of happening of the fraud. As I have told, whenever related party transactions are there, see, it is very much easier when compared with outsiders. It is a bit easier to perform frauds, to conduct frauds in case with the related parties. So that's why as an auditor, you need to study in deep the related party relationships and find out, is there any possibility of happening of fraud because of related party transaction. That is what the meaning of fraud risk factor, the possibility, the indicators that there could be a possibility of fraud being committed. So that also I need to find it out. So if we read it, the fraud can be easily committed through related parties. Hence, understanding related party transaction helps the auditor in identifying fraud risk factors. Number three, inherent limitations arising out of related parties. If you remember, when we discussed inherent limitation, one of the inherent limitations is related parties also. So the chances of auditor's opinion going wrong because of inherent limitations are much higher. So the same thing they say, in case of related parties, the significance of inherent limitations are greater. That means the possibilities of auditor's opinion going wrong are much higher in case of related party transaction, because of the following reasons. Why? Because sometimes management themselves may not be aware of existence of related party relationship. Sometimes management themselves will not understand who is the related party, who is not the related party, and related party relationships may present a greater opportunity for collusion and manipulation. Even in the case of related party chances, related party transactions, the chances for manipulation, collusion are much higher. So that's why the risk of that's why the possibility of inherent limitations is much higher. Or if I put it in other way around, the significance of inherent limitations is much higher in the case of related party relationships. If I put it in other way around, the chances of auditor's opinion or auditor's opinion going wrong, particularly because of related party transactions, is much higher because of the following reasons. And also, how you can overcome that your chances of your opinion going wrong? Simply by maintaining professional skepticism. If you maintain the professional skepticism, then audit risk can be reduced to a very low level. So this is what your auditor's responsibilities are. Very simple. We need to obtain audit evidence regarding accounting and disclosure requirements. We need to identify the fraud risk factors. We have to pay special attention to our inherent limitations, and even we have to maintain professional skepticism. The requirement of professional skepticism is much higher in the case of related party relationships. Next, Coming to the next point, how the auditor can verify existence of related parties. Say I'm telling, as an auditor, you have to identify who are your related parties, who are your clients, related parties, that you have to find out. But how you can find it out? By inspecting certain documents, whether there is a related party relationship or not. That how auditor can find out? By reading the following documents. So what auditor can do to verify existence of related parties? Go through income tax returns, go through the information provided to regulatory authorities like SEBI. You can even go through the shareholder register. By that, you will come to know who is having a significant ownership in the company. Even go through statement of the conflicts which are submitted by the board of directors. Life insurance policies acquired by the company. Go through their investment register. By that, you will come to know subsidiary associate companies. Go through contacts and agreements with the key management, with the top level management. You have to go through any contracts if you find which are not in the ordinary course of business, and even you have to go through internal auditors report. So if you go through all these documents, by that you will come to know the existence of related parties. Clear? So this is what SA 550 is all about. Hope you guys are able to understand this SA 550 as well.
So the next standard which we'll take up for revision will be SA 540. So SA 540 is also one of the most important standard. This standard is actually very big. It has a very lot of concept. So what I will do is, now in this series, I will try to revise this SA 540 in a very crisp manner. Somewhere in the span of 20 to 25 minutes, I will try to wind up the revision of SA 540. But if you want to have a detailed understanding regarding SA 540, there is already a video uploaded on this YouTube channel. There is already a video uploaded for SA 540 which spreads around somewhere around 1.5 hours, where I have explained in a very in-depth manner the contents of SA 540 in a much more conceptual and a detailed manner. So you can watch that video for full clarity. But now I will be revising. In this series, I will be revising quickly what is SA 540 talking about. So as you could make it out from the title, SA 540 is a standard which is going to talk about auditing accounting estimates, including fair value accounting estimates and related disclosure. So one thing is very much clear from this, SA 540 is the standard which is going to talk about accounting estimates, which is going to talk about what? Accounting estimates. Now, what are these accounting estimates? What they are referring to? As we all are aware, who is responsible for preparation of the financial statements? So financial statements preparation is a responsibility of the management. So the management of the organization will prepare their financial statements. But we know that while preparation of the financial statements, there are certain areas where management can't measure everything precisely. There will be numerous number of areas where the management will be required to make use of assumptions, estimates. Like if I have to give you a few examples, if you take depreciation, for the purpose of calculation of depreciation, management is going to make use of estimates. Depreciation is something which can't be calculated precisely. If I tell you even simple formula also, cost minus residual value divided by expected useful life, we say. So there are three components required for the purpose of calculation of depreciation. In that three components, one thing only which we can precisely know is cost. Realizable value is nothing but simply an estimation. Expected life is also simply an estimation. So depreciation is one such example where the management can't precisely calculate it. They will make use of estimate. Similarly, provisions, provision for bad and doubtful debts, or provision for liabilities, provision for contingencies. So this is also one such area where management cannot precisely measure. Here also they are going to make use of estimate. And if I give you one more example, a few more examples if I have to give, sometimes you are required to value your financial instruments. Sometimes you are required to value your do the valuation of your financial instruments like shares or derivative instruments, etc. So in some cases, for the purpose of valuation of that investments also, we use that assumptions and estimates. So like that, in the process of that preparation of the financial statements, there are numerous areas where management can't measure exactly. They can't do a precise measurement. They have to rely on some assumptions and estimates. So those estimates we are going to call them as accounting estimates, which we few examples are depreciation, provision, financial instruments. So all these are examples of accounting estimates. Sir, can the management of any company, can they prepare the financial statements without usage of assumptions and estimates? Can any entity prepare the financial statements without using one single assumption? That is quite not possible. It is inherent in the system. No organization can prepare their financial statements without using assumptions. There will compulsorily be certain assumptions in the preparation of financial statements. Now, as an auditor, how we can obtain audit evidence regarding that accounting estimates? That guidance is given under this standard. That guidance is given under this standard. So what guidance is given under SA 540? If as an auditor, we are conducting audit of some financial statements, while in the process of conducting the audit of financial statements, we need to obtain sufficient and appropriate audit evidence even regarding that accounting estimates also. But here there is a problem. See, if we know something exactly, then we can easily obtain audit evidence. For example, if the company has incurred one expenditure, 1 lakh rupees of expenditure they have incurred. Now, whether that expenditure is correct or not, it is little bit easy to identify. We can check the supporting documents, we can contact with the vendor, we can do various things. Similarly, in the statement of P&L, you are able to find that there is a amount, provision for bad and doubtful debts, 10 lakh rupees is there. Now this becomes a difficult for the auditor to obtain audit evidence. Why? Because provision is just an estimated figure. There is no actual substance of the transaction which has taken place. So that's why comparatively accounting estimates take a lot of effort, takes a lot of difficulty, and it is a little bit difficult matter for the auditor to obtain the audit evidence. So that's why standards thought, okay, in the obtaining of audit evidence of accounting estimates, we need to give guidance for the auditor. So that's why they have brought up this SA 500 to give the guidance to the auditor how he can obtain sufficient and appropriate audit evidence regarding accounting estimates. So that is what the objective of the standard also. If you read the objective paragraph of SA 540, it says, as this standard is expecting you to obtain sufficient and appropriate audit evidence in the context of applicable financial reporting framework, whatever accounting estimates which the management has made, are they reasonable? So as an auditor, this standard is expecting you to obtain sufficient and appropriate audit evidence. Whatever accounting estimates management has made in the preparation of financial statements, are they reasonable? Are they acceptable? And whatever disclosures which are required to be given in the financial statements regarding that accounting estimate, whether all that disclosures are given or not. Obtaining the audit evidence is your responsibility. So two objectives, what are they, guys? To obtain sufficient and appropriate audit evidence, whether accounting estimates which are used by the management, are they reasonable? Number two, whatever disclosures which are required to be given regarding the accounting estimates in the financial statements, are those disclosures given or not? So obtaining evidence regarding that is auditor's responsibility. Clear? So here we need to understand the definition of accounting estimate. So if you see here, an approximation of a monetary amount in the absence of precise measurement. When you can't exactly measure something, when you can't precisely measure something, you have to make an approximation, you have to make an estimation of one figure, one value. So that we call it as accounting estimate. And one more important area to understand here, for the purpose of this standard, we are going to divide accounting estimates into two categories. We are going to divide accounting estimates into what? Two categories. One is those accounting estimates which involve fair value and other accounting estimates. Those accounting estimates which require you to do fair values, which require you to consider fair values, and those accounting estimates which does not require you to consider fair value. Sir, what is fair value? Fair value means current market terms and conditions. Sometimes for the purpose of calculating some accounting estimates, we have to go and determine what is the current market conditions. So those accounting estimates which require you to consider the current market terms and conditions, that we call them as fair value accounting estimates. And other than whatever doesn't require current market terms and conditions, that we call them as other accounting estimates. So if I have to give you a few examples, so if you see here, examples of situation where fair value accounting estimates may be required. Sir, what are the examples of fair value accounting estimates? There are plenty of examples. Complex financial instruments which are not traded in the active or open market, like the client is holding some shares in an unlisted company. So now you have to determine its value. What is the value of that shares? That you have to determine after considering market terms and conditions. So simply valuation of shares is one example of fair value accounting estimate. Share based payments. Sometimes there will be something called share based payments. That is also example of fair value accounting estimates. And property or equipment held for sale, property held for sale, plant and machinery held for sale, you have to recognize its value. So if you are keeping some asset which is held for sale, you have to determine what is the current market value of this asset. If I sell this asset today in the market, what will be the value? That you have to determine. So when I say this, I am considering the current market terms and conditions. That is also one example of fair value accounting estimate. Or certain assets or liabilities which are acquired in a business, including goodwill. Goodwill valuation also considers market terms and conditions. So that is also a fair value accounting estimate. And transactions involving exchange of assets or liabilities between independent parties without monetary consideration. If you find any barter transactions have taken place, that is also an example of fair value accounting estimate, because there also you have to consider what are current market terms and conditions. Now, sir, what are the accounting estimates which does not require fair value? Like for example, allowance for bad and doubtful debts. There you need not go to consider any market conditions. Inventory obsolescence, it is also doesn't require any fair value accounting estimate. Warranty obligation, no need to consider what is the market terms and conditions. Depreciation, it is also one example of accounting estimate which does not involve fair value. So like this, we are going to divide accounting estimates into two categories which involve fair values, which does not involve fair values. So we have seen examples for both. Tell me where there is a little bit higher risk. In which kind of accounting estimates there is a significant risk? In 90% of the cases, the accounting estimates which involve fair value calculations, they have little bit extra risk. Clear? So what we have seen till now, we have seen what is the objectives of the standard. So what is the meaning of accounting estimate, and two types of accounting estimate we have seen. We need to understand one more important term associated in this standard, which is estimation uncertainty. So this is also going to be very, very important. So what is that? Estimation uncertainty. Sir, what is estimation uncertainty? Estimation uncertainty means, when I say accounting estimate, what I'm trying to say, something I'm unable to determine accurately. So that's why an estimate has been made. See, whenever I'm telling I'm making an assumption, I'm making an estimate, there is always a chance of that estimation going wrong. Since we don't know what is exactly the value, that's why only I'm making an estimate. No, whenever I say estimate, there is always a chance of my estimate going wrong. For example, you have given your examination. You have given your auditing attempt. So after attending the auditing examination, you came back, analyzed your answers, and you estimated that your marks could be somewhere around 56. This is your estimate. So when I say my marks could be 56, is there a guarantee when the results come out exactly your marks will be 56 in the audit? No. There is a chance you might get 55 also. There is a chance you might get 50 also. There is a chance you might get 60 also. There is a chance you might exactly get 56 also. That uncertainty will always be there. So whenever you make an estimate, there is always a chance. There is inherently a chance that actual figure might be different from your estimate. So that we call it as estimation uncertainty, which will always be there in the case of accounting estimates. Because you are using an estimate, since you don't know what is the exact value, this can't be avoided. Estimation uncertainty always will be there. So if you look at the meaning here, the susceptibility of an accounting estimate and the related disclosure to inherent lack of precision. There is no exact measurement, there is lack of precision. That means your estimate could go wrong. So that susceptibility, we are going to call it as estimation uncertainty. Now, there could be some accounting estimates which involve high estimation uncertainty. There could be some accounting estimates which involve low estimation uncertainty. See, whenever estimation uncertainty is higher, the risk is higher. If estimation uncertainty is lower, risk also will be lower. Able to understand this concept? If estimation uncertainty is higher, risk is also higher. See, if the chance of your estimate going wrong is high, that means the actual figures might also be very different. That means the risk is very high. In that area, misstatement chances are very high. On the other hand, if the estimation uncertainty is very low, you made an estimate, there is very less chance that this actual amount will be different. That means you have a very high chances that actual amount will be very close to estimate. That is a low risky area. So if the estimation uncertainty is high, risk will be high. If the estimation uncertainty is low, risk will be low. Sir, can you give a few examples where there will be low estimation uncertainty and there will be high estimation uncertainty? So we have here examples. So what are the accounting estimates? What are the examples of the accounting estimates which involve low estimation uncertainty, where the chances of your estimate going wrong is very, very less? So that means, for example, if I have estimated my provision as 10,000, there are more chances that the actual amount also will be close to 10,000. Less chances for uncertainty. Sir, what are that examples? Let us see. Accounting estimates that engage in business activities that are not complex. Sorry. So number one, if you are making accounting estimates relating to those business activities which are very simple, which are not at all complex, which are not at all difficult, that the estimation uncertainty will be low. There, most of the cases, whatever estimation you have made, that will be close to the actual value. So if the matters are not complex, then the estimation uncertainty will be low. And if you are making estimate regarding routine transactions, then also estimation uncertainty will be low. Similarly, when the accounting estimate is derived from the data that is readily available, you are calculating an estimate which is based on readily available data. There is no need to go for searching the data and generating data. The data is readily available. On the basis of that readily available data, you have calculated estimate. Then also the chances of that estimate going wrong are less. And also you are doing some fair value accounting estimates where the method of measurement is already given in the applicable financial reporting framework, and that can be easily applied. So you are making a fair value accounting estimate, but how to calculate that fair value, that is already given in the applicable financial reporting framework, and that is widely accepted. If applicable financial reporting framework itself is telling exactly what method you have to follow for calculating accounting estimate, then there will be no uncertainty. On the other hand, fair value accounting estimate, where the model used to measure the accounting estimate is well known or generally accepted. Once again, the same point. So these are the various examples where estimation uncertainty will be low. If estimation uncertainty is low, then the risk is also going to be a little bit low. On the other hand, there are some accounting estimates which involve high estimation uncertainty. High estimation uncertainty means what? For example, if I calculated some estimate to be 10,000, there are more chances that actual figure might differ a lot from this estimate. So what are that examples? Accounting estimations which involve outcome of a litigation. If you are recognizing provision regarding some litigation, what will be the outcome of litigation? We can't say. We are expecting that we might be required to pay a penalty of 10,000 if we lose a case, but actual liability might turn out to be 1 lakh. So here there is a high risk of high estimation uncertainty. If it is high estimation uncertainty, there will be high risk. Similarly, fair value accounting estimates for derivative financial instruments not publicly traded. If you are required to determine fair value of certain instruments which are not publicly traded, if the investment is publicly traded, if it is listed on a stock exchange, current market price will be readily available. But you are dealing in such an instrument which is not listed on the stock exchange, then also there is a high risk of estimation uncertainty. Or fair value accounting estimates for which a highly specialized entity developed model is used, for which there are assumptions or inputs that cannot be observed in the marketplace. Nothing but it is exactly opposite to this. So in the low estimation uncertainty, they told if you are making a fair value measurement where the method is already given in the applicable financial reporting framework, there is low risk, low certainty. However, if there is no method given in the applicable financial reporting framework, entity itself is developing its own model, then there are more chances for estimation uncertainty. So this third point is exactly opposite of this low uncertainty point. So this is what regarding estimation uncertainty. So we have seen what is accounting estimate. We have seen two kinds of accounting estimate. We have seen what is estimation uncertainty. We have seen examples of those accounting estimates which involve high estimation uncertainty, which involve low estimation uncertainty. Okay, we got to know about accounting estimates. Now let us try to understand what are auditors' responsibilities regarding accounting estimates. What are auditors' responsibilities regarding accounting estimates? So first, as an auditor, while performing risk assessment procedures, you need to identify what is the risk of material misstatement in the area of accounting estimates. What you should do? First, we'll perform risk assessment procedures. No, so while performing risk assessment procedures, you need to understand certain things which will help you to identify what is the risk of material misstatement in the area of accounting estimates. Sir, what I should try to understand? Like, you need to understand what is the requirement of applicable financial reporting framework regarding accounting estimates, what Ind AS is telling, what Schedule 3 is telling, what Companies Act is telling regarding accounting estimates. So first you have to understand requirements of the applicable financial reporting framework. Then you have to know how the management is identifying those events or transactions which give rise to accounting estimates. So which transactions need accounting estimates, which transactions does not need accounting estimate. Identifying that is management's responsibility. So you need to understand what steps the management is following to identify all those circumstances or events which need accounting estimates. Then you need to inquire the management whether there are any change in circumstances which require them to revise which requires them to new or need to revise their existing accounting estimates. You should also go and ask them, sir, are there any changes in the terms and conditions which require you to revise the accounting estimates which you have already made? So since in the area of accounting estimate, the risk is very, very higher, you have to pay much care to this area. So that's why while performing risk assessment procedures, you should try to understand this. What you should try to understand? You have to understand the requirements of the applicable financial reporting framework. You should get to know what steps management is following to identify all those circumstances which give rise to accounting estimate. You should inquire them, are there any change in circumstances which require them to revise the estimates which they have already made, and you have to pay a lot of care in this area. Clear? So that is the first step. You need to understand this. Next one, as I have told, you need to understand how the management is identifying their accounting estimates. How the management identifies the need for accounting estimates. Nothing but, so here if you pay attention, I told this. So you need to understand how management is identifying events or transactions which give rise for accounting estimates. Now, how he can do that they are explaining it in a detailed manner. The point, whatever they have given here, how he can do that, how he can fulfill that they are explaining it in a detailed manner. So what things you need to understand, how the management is identifying those events which require accounting estimate, what you should do. Let us see. First one, in preparing financial statements, the management is having the responsibility to identify all the transactions or events that give rise to the accounting estimate. And after they have identified, it is their responsibility to do the correct accounting estimates and give all the disclosures. So it is whose responsibility to identify events which give rise to accounting estimate? Management. After identifying, it is whose responsibility to create accounting estimates and give the disclosure? It is always the responsibility of the management. So that's why as an auditor, you have to go to the management and inquire them. Sir, what I have to inquire from them? Whether the entity has engaged in new type of transaction, which is giving rise to need for new accounting estimates. And also, I should try to ask them, are there any change in the terms and conditions which require you to create accounting estimates now? Nothing but I will try to understand what new transactions they have entered, what are the terms of the transactions, and also I would try to understand what accounting policies they are following regarding accounting estimate. Is there any change in the accounting policies? And finally, I need to understand what are the laws and regulations which are applicable for them and any new conditions or events are there. So go and inquire with the management. By that, you will come to know how the management is identifying their subsequent events. Then after I have understood how the management is identifying their subsequent events, then I need to understand how the management is calculating that accounting estimates. So first step, they have to identify. After identifying, they have to calculate that accounting estimate. No. So I have to even understand as the management how they are calculating that accounting estimates. Sir, how can I get to know about it? Once again, you need to speak with the management and you should understand what method or model they are using. What kind of model they are using, what kind of method they are using for making accounting estimates, what controls they have established, what kind of internal controls they have established. Did they take the help of any expert if they have to create any provision for litigation? Did they take the help of a lawyer if they are required to create a provision for employee benefit expenses? Did they take the help of an actuary? So determine, have they taken the help of any expert? And also what assumptions they have made, what kind of assumptions they are making, and whatever assumptions they have made, are they see here the assumptions underlying the accounting estimate, and whether there has been or ought to have been a change from prior period. The methods, last year what methods you have used, current year what methods they are using, there should be consistency. If you find last year they use some different method, current year if they are using some different method, try to understand what is the basis for that change. And also whether and so if how management has assessed the effect of estimation uncertainty in whatever calculations they have done, what is the effect of the estimation uncertainty, that also have to understand. So when it comes to auditor's responsibility, what is the first one? You need to perform risk assessment procedure to understand these things. Then you need to understand how the management is identifying the events which need accounting estimate. Then I need to understand how the management is making the accounting estimate. Then I need to understand about estimation uncertainty also. If I find that estimation uncertainty is high, then that area will be high risky area. So if you find in certain area estimation certainty is high, that means there is a high risky area. That area you have to handle in a better way. So what you should do? So if you see here, for accounting estimates that give rise to significant risk, when accounting estimate give rise to significant risk, when there is a high estimation uncertainty, it will give to high risk. Then the auditor should evaluate how the management has considered alternative assumptions. If they have used one assumption and created a provision, now I should evaluate why they have not considered alternative assumptions. If they have taken depreciation for useful life of asset as 10 years, I should analyze why 5 years can't be appropriate. So we have to judge that. And what is the management intent to carry out the specific course of action and its ability to do so? If the management has made an assumption, is it a realistic assumption? Is it a realistic assumption? Are they able to fulfill that assumption or not? That also I need to check. And also the auditor should develop a range within which to evaluate the reasonableness. Finally, the auditor will also do some calculation. He will develop a range. In this range, generally the accounting estimate will be, like for example, auditor will use his experience and he will determine that, okay, in this kind of company, the provision for depreciation for plant and machinery should be somewhere around 10,000 to 15,000. So he will develop a range and he will check whether really management's accounting estimate is also falling within the range or not. So this is what you should do if you find there is a high estimation uncertainty which is giving rise to significant risk. Finally, after doing all that, you have to evaluate whatever accounting estimates which are made by the management, are they reasonable, and determine is there any material misstatements in the accounting estimates. So these are the 5 steps of auditor's responsibility. So what are they, guys? Number 1, risk assessment procedures. Number 2, you need to obtain understanding how management identifies the events which requires accounting estimates. Number 3, you need to understand how the management is calculating that accounting estimates. If there is any estimation uncertainty, you have to follow certain things. And finally, you have to evaluate all the reasonableness of the accounting estimates and determine whether there is a material misstatement. So these are auditors' responsibilities. Now they say certain things regarding accounting audit procedures also. See, audit procedures once again more or less same. First, you need to identify risk of material misstatement. Same like as we have seen above, we will perform risk assessment procedures and we'll try to determine whether accounting estimates are giving rise to risk of material misstatement, and wherever estimation uncertainty is there, there will be significant risk. So that's what you should do. So first you should identify risk of material misstatement in the area of accounting estimates by performing risk assessment procedures. So once you identified risk assessment, once you identified risk of material misstatement in the accounting estimates, you have to respond to that. How we can respond to that? By performing further audit procedures. When I say further audit procedures, it includes compliance procedures, it includes substantive audit procedures. So all that you need to do, like for example, if you see here, I need to verify events occurring up to the date of auditor's report. If the management has created a provision, if the management has created an accounting estimate, I should check till the date of audit report any extra evidence is available, either confirming or opposing that accounting estimate. So check that events which have taken place up to the date of auditor's report. Test check, take a sample of accounting estimates and do the calculation. Check the methods, whatever they are using. So recalculate that methods once again. Testing the extent to which the data on which accounting estimate is based. So on whatever data the accounting estimates are built, are they accurate? Are they complete? Are they relevant? That means the data used for calculating accounting estimates, is it proper data or not? Check that. Consider the source for the data, from where they are getting that data for accounting estimate. Check the source. Do the recalculations. You also know how to do the calculation of accounting estimates. So do the recalculation on your part once again. And test check the effectiveness of controls. Nothing but you should also perform compliance procedures over the controls operating over accounting estimates. And if required, you can even take the help of expert as well. So this is what the auditor's procedures. First, you perform risk assessment procedure to identify risk of material misstatement. Then you perform further audit procedures to respond to that risk of material misstatement. And then finally, you need to check whether all the disclosures regarding accounting estimates are given or not. So as you could see here, the auditor should obtain sufficient and appropriate audit evidence whether disclosures regarding accounting estimates are given as per applicable financial reporting framework. If there is any significant risk, the auditor should also evaluate adequate disclosure of estimation uncertainty is also given. If certain accounting estimates carry high risk, I should ask the management to give disclosure regarding estimation uncertainty also. Generally, what disclosures are required to be given regarding accounting estimates? So these disclosures are required to be given, not by the auditor. As an auditor, I should check whether management has given these disclosures regarding accounting estimates. So particularly with regard to estimation uncertainty, these disclosures are required to be given by the management. Like they have to clearly disclose what assumptions they have used for making that accounting estimates, what method they have used for making that accounting estimates. Is there any the basis for selection of estimation? So on what basis they have selected that estimation? Any change when compared with the last year? In the current year, have they made any change in calculation of the accounting estimates? And from what sources they have collected the data? What is the impact of estimation uncertainty? So as an auditor, you need to check whether all these disclosures are given by management in the financial statements. If you find these disclosures are missing, you have to give a modified opinion. You have to give a what? Modified opinion. Then in addition to that, you need to obtain written representations from the management also regarding the accounting estimates. And finally, whatever work you have done regarding accounting estimates, you need to document also. So on what basis you have taken the conclusion about the accounting estimates? So is there any bias? Did you find any bias? The management while making an accounting estimate, did they not show any neutrality? Did they show any bias? Are they partial towards any method? So that also you need to document. Complete documentation is also required to be made regarding accounting estimates. So this is what completely SA 540 is talking about. So I know a lot of concept is involved in this SA 540. As I have told, this is only a revision. If you want to know more about SA 540 in a detailed manner, just go and watch the video. Detailed video SA 540 will be there. So just go and watch it. All your things will get sorted. Clear, everybody? So that's all for now. See you in the next series.